Hello, everybody, and welcome to Fool24, where we are now broadcasting both to members on Fool.com as well as to a live feed on YouTube. So, for the people who are just joining us on YouTube, welcome, and thanks for sticking with us for all of the members who have been with us for the previous hours as well. My name's Tyler Crow. I am, as the Chiron explains, I'm the nomadic fool, I guess, if you will, kind of the person who calls in from places remote around the world, currently coming from Tbilisi, Republic of Georgia. And joining me for this hour of tech and power is Hawaiian shirt enthusiast Danny Vina. We're looking forward to your hours. Please get your questions in to go to slido.do with the code Fool24 if you want to get your questions in. For those of you who are on joining us through YouTube, just do keep in mind we have moderators for questions. So everybody, let's keep it polite and civil, shall we? And also, as you can see with the Chiron down below, we are not here to give personalized financial advice. This is for educational purposes only, and we, are glad to share our experiences, our expertise, and our personal views on certain things. But please don't misconstrue that as personalized advice and things that you should do with your money. Danny, how are you doing today?
I am doing well, Tyler. The sun finally came out here in San Diego after a couple of days of cloudiness. So, we're reveling in the sunshine. The Hawaiian shirt is ready to go. And we are ready for an hour of power and tech.
Yeah, so we came up with the rough idea around power and tech being the idea of there's a lot of talk in tech these days of AI. I'm trying to think of autonomous driving, all of these things that are driving massive amounts of compute power. And last time I checked, all those, when you say power, it means there has to be something actually powering it. And so one of the things that we are going to be talking about is how these sort of interplay. And so Danny's probably going to handle much more of the tech questions, and I will probably handle a little bit more of the power, energy, anything related to that sort of industry compared to everyone else. So with all of that in mind, Danny, looks like you've got a question already lined up that you're seeing in the chat. How do you want to start? Why don't you hit that, and then we'll get going here.
Sure. Well, I'll go ahead and hit this. Now, I want to start by saying, Arista Networks is a company that a lot of folks follow. The company reported their earnings results last night. They beat expectations on both the top and bottom line. But today, the stock is languishing a little bit. It's down about 6%, which leads to a question from Sherry Thomas from a couple of hours ago. And Sherry asks, could you please explain why the stock is going down when the earnings report was positive? What would you do if you have a current position in it? I actually do have a current position in it. And to give you a little bit of background, Arista Networks provides a lot of the technology that is used in data centers. So it's got a lot of yeah, sorry, I'm looking at this at the same time. So Arista Network has a lot of the components that go into data centers and help move data about the ether. And one of the things that came up on the conference call was the fact that Arista Networks, one of its biggest clients is Meta Platforms, the owner of Facebook. And another big customer is Microsoft. So you would expect that the big build out in data centers that has been happening would be to the company's benefit. However, analysts have noted that it looks like Facebook may have spread the wealth a little bit. And rather than just putting all its eggs in one basket and using Arista Network solely for its build out. It has used another company as well. And so analysts are kind of concerned that, there's a potential here that Arista Networks might suffer from, this. It looks like they lost some of their business with Meta to a contract manufacturer called Celestica, ticker CLS. Now this was kind of news to me. I wasn't aware of it either. It's something that I looked up when I saw the question. So I would say, as a shareholder, this is not something that I am going to worry about at this point. Obviously, when you are looking at the data center build out for a lot of your growth, the loss of any customer or a portion of any customer business could be concerning. But over the long haul, I don't think it's an issue because obviously Meta is not the only game in town, and they are continuing. The data center space is building out at a ridiculous pace. I don't know if this is something that you can talk to, Tyler, but just from the specific view of a Arista Network shareholder. I'm not planning on taking any action. I'm certainly not selling the stock. I will monitor this going forward. If they were to lose more business, I might become concerned. But a one-off like this, I don't see an issue.
You know, this is again, my weakness in tech overall is showing here because I think I've maybe heard the name Arrested Networks like 5 times. So I don't really have any thoughts or comments on it. I tend to be a little bit buried in the energy stuff. And I was trying to do a little bit of homework while you were answering your question because we did get quite a few questions, almost specifically around one. Oh, there's like 3 questions in the queue at various times related to one company, Devon Energy, which is a oil and gas producer. There are several iterations of more or less the same question related to Devon Energy, but I'll just use Ed's question from 2 minutes ago. It says Devon Energy has very good earnings. I don't understand why Motley Fool analysts don't like this stock. So, as I mentioned, Devon Energy is a oil and gas producer with heavy exposure mostly to North America through shale production, most of it being in the Permian Basin with also some assets across other shale formations in the United States, most notably the Bakken Formation in North Dakota, as well as Eagle Ford, which is in South Texas area. As far as operators go, this is a pretty quality business. It's hard to say anything too derogatory about it. I think they keep a pretty good balance sheet. Their free cash flow has been pretty good, and I think for so many years when it came to how would I call this, like the for the 2010s and basically like the starting right around like 2015, we had like shale production booming in the United States because we had really unlocked it and figured out how to do it commercially viable. But at the same time, it was right around when a massive wave of like mega projects were coming online, big offshore oil platforms here and in the Gulf of, what was then the Gulf of Mexico, I guess. Depends on what side of the border you are now, how that's named. There was big things coming from like the Arctic Sea in Russia, the Norwegian continental shelf. Brazil was having a real moment with its offshore oil. So 2015 all it kind of came to a head where we just had so much production coming online at the same time that I think there was a lot of investors who have just felt burned by the idea of investing in oil again and being like, well, so many of these shale producers during that 2015 time, despite the fact oil production was low, they continued to, you know, do the one thing that they know how to do and drill their way out of it, right? Continuing to spend capital expenditures and things like that. If we get enough production, we can make up for the lower prices. And a lot of companies in the industry suffered because of it, because it just kind of prolonged the downturn in shale. And so it seems like most oil and gas producers in North America through a combination of consolidation, through a combination of, we'll call it shareholder revolt, if you will. Many of them found the religion of capital discipline, being much more moderate with their growth production, how to actually grow their production without, overstretching the capabilities of the oil demand to actually absorb it. So they've been much better about that, returning copious amounts of cash to investors, either through buybacks or through a dividend. So Devon, in that regard, is, I would say, a quality company. The couple things, if I were to pick nits with Devon specifically, is it is all in on shale in the United States, and it's been a very good productive asset for quite some time. But some places we're starting to see, like, some of the drilling, some of the results from wells are becoming not quite as optimal. Some of the places, like, for example, you have this thing called the oil to gas ratio. It's basically like how much gas is in an oil well. When we were really hitting some of the prime targets in the Permian Basin, it was like 2 to 1. So two units of gas for 1 unit of oil, where today it's getting a little bit closer to 3 to 1 units of gas to oil. So it's a little bit less lucrative as it used to be, throwing off a lot of gas relative to its total production, which at this time, you can go see gas prices and oil prices in the United States. Gas is much cheaper, and if you even do it on what's called an energy equivalent basis, it's even cheaper too. You look, natural gas, I think, on an energy equivalent basis is something like $25-$30 per barrel. So it's just not quite as productive of an asset. So if we were to see a continued deterioration in the oil to gas ratio for shale, that could be an issue. And absent any like major bids to do some longer tail development and exploration. I'm talking about doing offshore drilling again, maybe looking in some of those more adventurous places that we haven't typically found oil before. There is going to be a need to do that sometime down the road. I don't know when that is, because we've had a pretty good stable of projects coming online in the oil and gas industry. But shale has been very good. We've still probably got several more years of productive assets, but 10, 15 years down the road, there is a real question: is how much we just continue to tap shale in the way that we have and get the same results that we have. And so I would be interested to see if Devon Energy has a plan to get out of outside of just shale again. They used to be prolific in like oil sands in Canada as well as offshore drilling, but they went shale only. So that they're capable of doing it if they want to. It's just that they want to, they're keeping down this shale path for quite some time, and I'll be interested to see how this goes from there. They'll obviously, their investor presentations be like, well, we've got decades of drilling inventory to do it, but that's always price dependent. We'll see how that goes.
So I wanted to spend a little bit more time on Arista Networks, because that was one of the tech companies that reported yesterday. And I went back to take a look at what the company reported, and just to kind of get a better idea of what investors were seeing. Now, the company reported its fourth quarter results yesterday after the market closed. And they had a quarterly revenue of about $1.9 billion. That increased about 6.6% 6.6% sequentially, and about 25% year over year. So that was, that's fairly solid growth. The company generated net income for the quarter of about 62 cents per share, up from 48 cents. Again, not a bad result there. Now, they talked about that Meta Platforms had deployed Arista's distributed Ethernet switch for its latest Ethernet-based AI cluster. The company listed a lot of, customer wins over the course of the quarter. Also said that they expect revenue of about $1.95 billion in the first quarter. So, I looked at a lot of this stuff. And just for those who might not follow Arista Networks very closely, this is a company that um, I lost my spot here. Sorry about that. That created Ethernet switches that result in very little lag time when you're moving data around the data center and from data center to end use cases. So they've done a remarkably good job at that. It's a company that I have followed, fairly well for some time. Um, their initially their claim to fame was these network switches that were designed for high-speed servers and other devices that were linked to a network, resulting in near instantaneous response times. But they have expanded beyond that. They have a whole suite of offerings, switches, routers, and other network equipment that's used to move the data between servers throughout the data center across networks. And they recently developed what they called a specialized Ethernet system that was specifically designed to handle the demands of large language models, which form the foundation of generative AI. Um, so, I think that the company's results here are pretty solid. They were better than what analysts expected. And as our viewer noted earlier, the stock was down a little bit. And that um, is, we're assuming that the reason that the stock is down is because there's some question about how much business the company is going to get from Meta in the future. Um, Again, as I said, I don't think that's a great concern. I think this is something that bears watching, but not an issue for the moment.
So I'm going to hit a question here from Kent about 15 minutes ago because I already answered half of his question because he asked about two companies. He asked about Devon Energy and he also asked about Alliance Resource Partners. The ticker is ARLP. I want to do my like Obi-Wan Kenobi like impression, be like, I haven't heard that name in a long time, but it's a coal producer in the United States, and for the longest time, when I was following the coal industry a little bit more intimately, it was one of the best operators in the business in terms of managing costs, in terms of its development pipeline, and being able to kind of live within the constraints of the coal industry that for much of the 2010s and in the early 2020s, for much of the electricity generation capacity in the United States, up until I want to say like a couple of years ago, I would say that how would I say this? Energy demand or electricity demand had been quite flat for a really long time. And basically, what we were doing with investments in electricity was kind of replacing old uh, generation assets like coal plants, maybe some old gas plants or something like that, that had, reached the end of their economic life. Nuclear decommissioning some nuclear facilities as well, and replacing them with new assets, whether that be new combined cycle natural gas, whether that be wind, whether that be solar. There would, we basically had portfolio turnover in the electricity generation mix in the United States over the past like 15, 20 years, because growth in the industry was so tepid. Um, as a result, many of the coal companies really struggled during this time because they were trying to manage declining demand. That for much of the 2010s declined much faster than they had originally anticipated. I do remember the uh, Energy Information Administration at it's a government agency, EIA.gov. It was a great like source of information. It was always surprising to me because the projections that they had for coal use, they seem to overshoot demand by multiple percentage points almost every year, because we were seeing so much seeing things retire so quickly. Um, Today, though, we are, in a new a kind of a new paradigm when it comes to electricity demand in the United States because we have been talking about AI. We're talking about electric vehicles, moving more even some like industrial manufacturing facility capacities that were done through either coal-fired generation or gas-fired for heat. We're actually looking towards electricity, steel mills with electric arc mini mills, things like that. So electricity demand has been growing to the point where we're all kind of looking around and be like, well, how do we manage demand growth? And part of managing demand growth is going to likely be either the unretirement of some of these older coal assets, maintaining coal assets that were supposed to be, scheduled to go offline, because it's going to be really hard to ramp up electricity demand as much as we have heard all the stories of, nuclear, renewables, things like that. When you start to see percentage points gains year over year in terms of electricity demand, that is a lot of electricity. That's a lot of power from gas plants, coal plants, whoever, and they will be running at significant capacity for a long time. And so for a company like Alliance, who, like I said, was one of the best operators, this does look like a slightly more favorable environment for them. That they cut their dividend. I think I want to say several years ago, and part of doing so was because they were struggling to get financing. A lot of like banks weren't actually issuing to coal companies to meet like emission standards, and trying to get debt that they were selling to investors that didn't meet certain standards. So they had a couple cuts. They had one in 2016. They had a couple in 2020, but it does look like they have more or less repaired their balance sheet to a manageable level. They've maintained a dividend payment that's the exact same since 2023, but it is a pretty generous one. It pays about 10.4% today. I know that coal stocks might not be everyone's cup of tea, but this is certainly one of the more quality operators that generates, at least today, is generating a much more favorable return. This next year, we'll see. Pricing has come in a little bit weaker because gas has been a little bit more prevalent, but that's kind of the natural swings of things when it comes to coal versus gas versus all the electricity sort of things.
So I've got a question in the queue from Ted Has Options from several hours ago. And Ted says, looks like the market liked Appian earnings, ticker APPN, after the market closed. Any early thoughts? And Appian is actually one of the companies that I took a look at this morning to see, what was going on with the company. And what I'd like to do here is I'll go ahead and share my screen so that we can actually look at the results in real time here. And so I'm going to expand this a little bit so we can see it a little bit better. And so Appian reported their fourth quarter results. It looks like that was actually early. I thought it was yesterday, but actually it must have been first thing this morning. So revenue came in at, let's see here, because they talk about their cloud subscription revenue, professional revenue. I like to look at the total first. So total revenue was 166.7 million. And just looking at my notes here, it looked like the analysts were expecting 164 million. So they beat on the top line. And it's great that their cloud revenue was up a little bit more. So cloud revenue grew at about 19% year over year. And their total subscription revenue grew about 18% year over year. So this is something that I like to see because this is the stronger part. This is the fastest growing part of their business. Services revenue only grew about 1%, but that's really just ancillary revenue in my opinion. So the fact that the company was able to deliver revenue growth, the market seemed to like that. The company also delivered a retention rate of 116%. And what that tells us is that not only is revenue growing among current customers, but existing customers are sticking around and spending a little bit more money. Scrolling down a little bit here to the bottom line, the company still delivered a net loss of about 18 cents per share, compared to 14 cents in the year ago period. Now on an adjusted basis, which is sort of what Wall Street looks for, um, they had a $14 million loss that was part of a foreign currency exchange losses, which is really something the company has no control over, because foreign currency exchange rates are what they are. It's not part of the company's operations, so I don't really hold that against them. So the results would have been a little bit better. Now their non-GAAP per share loss was about break even, compared to 6 cents in the prior year quarter. And again, looking at the results, it looks like Wall Street was expecting them to lose a penny per share rather than break even on an adjusted basis. So the company actually beat that. Now, the one other thing I wanted to point out here, they go over the full year highlights, but when you get down here and look at their revenue guidance for the first quarter, um, the company said that they're expecting roughly $163 million in revenue for the quarter. That's also above what Wall Street was expecting. So I think Appian, and for full disclosure, somebody asked about Appian a couple of days ago, and I looked at the situation and said, I see some challenges ahead for the company because of the proliferation of generative AI. Appian is a company that helps developers um, create apps by simplifying the code writing process. And with generative AI models, there are a lot of uh, apps out there now that will help write code, which essentially is causing Appian growth to slow because they have more competition than what they've had in the past. Um, Now that said, as an Appian shareholder, I am pleasantly surprised because the stock is doing much better than what I expected it would be doing. Looking up the results, or the stock price right now, it looks like Appian is, let's see here. Um, yeah, the stock was up about 17% last I saw. I think right now it's up about 21%, which is remarkable, given the results were a little bit better than what investors expected. But again, I think one of the things we're seeing in the current market is that when a company under promises and over delivers, they're rewarded. And when things don't come in as well as what the market is expecting, the stock is punished. So a good solid quarter from Appian. I think the company is doing the things that it needs to do. I still have a little bit of concerns about the future, but it's certainly one that I'm going to keep an eye on.
I'm going to hit a quick non-stock one because I see Mike G was asking about life, or why I'm in Georgia. It's not for another job. It's for my wife's job. So that's why we're living here overseas. Been doing the overseas thing for about 9 years, going from country to country for my wife's work. Sasha B asked, Brookfield Renewable Partners seems like a good stock for the intersection of power demands and renewables, yet the stock has lagged. What is the reason? I, here's the I we are all individual investors, right? We kind of think of picking stocks and things like that. But just for a moment, I want us all to just kind of put on our institutional investor caps for just a minute here, because it is an important way to frame why it has lagged for the way it has. Brookfield Renewable Partners and its kind of corporate assimile, Brookfield Renewable Corporation (BEPC), they are owners of renewable power assets. It started out with a base of Colombian hydroelectric dams. It's moved into solar and wind. It's getting into batteries. It's also getting into other forms of power generation and things like that. And Brookfield does a pretty good job of, we'll call it like portfolio management. If they can get a good deal on an asset, they'll sell it and then develop another asset elsewhere. So they're a little bit like a active portfolio manager of renewable assets. Um, if you look at the history of the business, it has been spectacularly steady. It Management has grown its funds from operations, which is kind of a proxy for cash flow, with a lot of with businesses that are hard assets that have lots of depreciation. It's FFO is commonly a thing that you'll see when it comes to businesses like this. Also in real estate, they'll use funds from operations. If you look at this business, they have almost set like clockwork grown their FFO per share 6 to 9% annually, which is fine. That's a pretty good rate. But when it's so predictable in that regard, you can pretty easily price what makes it attractive relative to what else is available in the market, because as Brookfield Renewable Partners and us with our institutional investor hat put on, we see something that is equity. So we are the last in line to get paid if something goes wrong with the business, and we are also taking on the most risk. And so we should get compensated for the additional risk that we are taking on as equity versus debt, making a debt instrument. Now, typically, if you're, something like that, if you have lower yields in debt, you're willing to take a little bit yet less yield in equity because you're trying to, making that adjustment on, what we'll call risk adjusted returns. And so through like 2019, 2020, 2021, where we saw interest rates drop to zero, a lot of our lower risk assets like debt, like treasuries, some alternative assets as well, they were priced at lower yields, and because they were priced at lower yields, they you know be it made them more competitive, or it made Brookfield more competitive relative to them. And that's why we saw from like 2019 to 2021, it was a business that went from having a yield of like 8% all the way down to like 3.5, because lower interest rates meant that there was demand for something that had higher yield. Since 2021, 2022 happened, we've seen this increase in yields, with interest rates rising, mortgage rates rising, a lot of the other world of higher yield, maybe less growth assets out there, but less risky, have become more competitive. They're commanding more attention from an institutional investors platform, because they need to make sufficient returns, but also like manage cash and all of those other things. And so, because it was a more competitive environment for alternatives, that's why we started to see a lag in Brookfield Renewable and Brookfield Renewable Partners, is because you know other people were just looking at it and being like, well, at 3% yield that's growing 5 to 9%, that's like what's that, somewhere between like 8 to 12% annualized returns. That's okay, but that's not great. And so you kind of needed to competitively price it on that risk adjusted return basis. Today, now though, we have that's the dynamic has changed a little bit. Brookfield Renewable Partners today has a yield of like 6. And when you add a 5 to 9% dividend growth on top of that, you have a 11 to 15% annualized return, which is a much more attractive position now relative to what it was priced earlier. So I think one of the reasons that we have seen this is because of interest rates. There might be some concerns from the market, the animal spirits of the market, if you will, maybe a little bit concerned about the new presidential administration's views on renewable energy. The one thing that I would just keep in mind with Brookfield is this is a global company. They can invest globally. If the United States market for solar and wind is not as attractive to them, They can go to Australia, they'll go to Europe, they'll go to Latin America. They've clearly shown in the past that they can do this before. And so as far as a U.S. renewable story disrupting this business, I think that might be a little overheated relative to the investment opportunities that this company has globally. So I think that should more or less get to the heart of your question, and I hope that does it. Danny had to step away for a few minutes to get some stuff sorted out. So I'm gonna take another question or two here while he figures this out. STG, kind of off topic of power and tech, but looking for solid international ETFs. And this is a fascinating question because with ETFs, it's like choose your own adventure in the publicly traded markets today. Like if you're looking for international exposure can be carved up in so many different ways these days that you can get exposure to an individual country. You can get global exposure ex United States. There's ETFs that do that. You can look at developed market international ETF. You can look at emerging markets, and it can be carved up in a multitude of ways. So what I would rather than say international ETF because that can, there's so many ways that can be carved up in slice of dice. What I would suggest to you is to think about what you want to do with an international TTF. Kind of the questions that you should ask yourself. Why do I want to do this? Do I just purely want broad exposure of things outside the United States? Or maybe there's a dynamic market in emerging markets or in Europe or a country or something like that I'm looking at and I'm really interested in investing in. Think about those questions first, and then you can basically Google search for it. Be like, uh, Swedish ETF or something like that, and chances are there's a ticker will pop up. So that would be my best suggestion for it because there's so many options that you can go in this direction that it may require a little bit of like contemplation as to what you want precisely. Danny, you're back.
I am back, and I was actually looking through the queue a little bit, and I found actually a couple of questions about Cloudflare, ticker NET. The first one was from SB. Any thoughts on Cloudflare? It looks massively overpriced at 30 times 2025 sales, growing at 25%, but still unprofitable. Would this be a good short candidate? Let me start by saying that as an investor, I personally do not advocate shorting. And the reason that I do not is because of one of my favorite quotes by economist Alan Greenspan, who was quoting another economist.
He's
and
not a
said,
spring chicken.
uh-huh,
It's been a minute since he said anything.
I know. But the quote that I don't remember who originally said it, but he quoted it. And essentially, it is that the market can remain irrational longer than you can remain solvent. So, shorting any high growth stock can be an extremely risky venture. I personally do not advocate shorting for any reason. Now that said, I do agree with your assessment that at this point, Cloudflare does look a little bit overpriced. I pulled up the screen here. It looks like it's got even from a forward basis, it's got a forward price to sales of 21. It's got a forward price to earnings of 205. I mean, we're almost getting into Palantir territory here. In terms of being overpriced. And this was the same question that Ted Has Options asked a couple of days ago, saying, any thoughts on Cloudflare's earnings priced to perfection at 36 times price to sales? I did go and look at the company's growth. They had fourth quarter revenue that grew about 27% year over year. They still had a loss from operations. Now that loss from operations was about 35 million. That was an improvement from the prior year. One of the things about high growth companies, and this is still a relatively high growth company, although, at the moment you look at it and say, well, growth of 27%, that's not that high growth. But this is a company that is, going through some adjustments internally. Yes, they're still generating losses. Their GAAP net loss was about 13 million. Now that was compared to uh, a loss of looks like 28 million in the fourth quarter of 2023. So that they're improving. They are moving from closer to profitability. On an adjusted basis, their earnings per share went up from 15 cents to 19 cents. I have not looked deep enough to know what exactly they're making adjustments for, but this is what the market was looking at. And finally, they have cash and equivalents of about $1.9 billion. That's a lot of money. So the company has a solid foundation, to fall back on. I think their results, while they were not stupendous, they were certainly solid. I agree with both SB and Ted has options that the stock is certainly high priced. And if this is a stock that someone is interested in purchasing, one strategy that I use is I buy a small amount of it. I keep an eye on it. It's a very small part of the riskiest part of my portfolio, just to keep an eye on it. And if you find better value points, you can, buy it if the stock falls, which it inevitably will. So those are my initial thoughts, high level thoughts on Cloudflare. And yes, I think it's overpriced.
Danny, I'm going to take a comment in here and I'm going to turn it into a question that I think both of us can answer. So I
Okay.
need input asked. He said, I was surprised you haven't stumbled upon some international stocks. He mentioned Topicus, Lumen Group, and Evolution AB, mostly overseas, either trading in Canada or trading on the Swedish market. So I can't say that I'm 100. I know I've heard roughly of Topicus. I can't say I can make any comments on this. Well, I guess we can maybe leave this for somebody else who might have some thoughts on these at another time. But, you know, obviously, all of us kind of, come into learning about companies in our own way and researching new companies and things like that. So, just to give like a reflection on how like I go about like my week of like learning new companies, I'll read like one or two IPO prospectuses a week because IPOs are always coming to market, and so I'm just kind of trying to see what's available out there. Tend to focus on maybe some of the larger IPOs or things that are maybe U.S. listings or things like that, because there's a lot of like blank check companies that are used for SPACs and things like that go public. Those aren't worth my time, but I'll do that, and then I will do one a week. I will read a 10K, a proxy statement, and about 10 years of financials for a company. And that's kind of my weekly learning about new company experiences. And so, at that pace, there's only so many that I can kind of keep on my radar at any given moment. So, and that's kind of my research process on learning companies and figure out what's interesting to me. I would really like to know, Danny, like how when you're like you're maybe in like your workly week flow when it's coming into things like this, how do you go about your like acquiring new knowledge on companies and at what frequency?
I don't have a specific process for specifically seeking out new companies. I have a lot of companies already in my portfolio that I follow. One of the things that I do like to do is I spend a lot of time looking at companies' earnings results, looking at a company's investor presentation, going back and looking at the Securities and Exchange Commission website, EDGAR, and seeing what they might have put in a regulatory filing that may not show up in the earnings report, because companies sometimes do that. If they're not required to say it to everybody out loud in the media or put it in their earnings report, they don't. But they may be required to file something with the SEC. So, for instance, is the company investing in other companies? I look for their 13F and see who are they investing in. Are there insiders buying or selling stock? I kind of like to look at that from time to time. Um, and primarily because, I know a lot of tech companies give away a lot of stock options to their top executives and to their employees. And that's a large part of their compensation package. And one of the things that you will see occasionally is you'll see articles come up and say, the CEO just sold, $200 million worth of stock. But then you go back and look, and this is stock options that they've held for the past 5 years, that they've been hanging on to until they reached maturity. And maybe it's the time of year like right now when you're going to see a lot of executives are going to be selling some of their old options, or selling stock because they have upcoming tax obligations, as we all do. Um, so I like to look at a variety of things. Um, I sometimes will be on the show and somebody will mention a company or a ticker, and I take a look at it and think, well, that's interesting, and maybe I'll go spend a little time looking at that. So I don't have a specific process in terms of specifically looking for companies. I have enough of them come across my radar by virtue of the job that I do. So that's one way.
All right, so I'm gonna take a question here from I Need Input because we're gonna talk about one of my pet favorite topics: Mexican airports. Not in tech and power, but hey, you know what? Let's throw a curveball here for a minute or so. So I Need Input asks, says, "Hi Tyler, I know you're bullish on ASR is the ticker, which is Aeroportuario del Sureste, which is Southeast Airport, and I'm curious why you're not bullish on ticker PAC, which is Aeroportuario del Pacifico, and OMAB is the ticker, and that's Aeroportuario del Centro Norte. These are basically the three operating entities in Mexico for airports. The Back in the 90s, the Mexican government kind of carved up the airport industry into these public-private partnerships. The private end of these things were, listed on the public exchanges, and they're more or less carved up geographically. It's pretty easy to understand. You have the Southeast, you have the Pacific, and then Central North. The one airport that isn't operated by any of these is Mexico City. That's still held pretty tightly by the government. I can't say I'm like any more bullish one way or the other between Sureste and Pacifico. I bought Sureste at the time. I was debating between the two, and I think at the time I thought Sureste had a slightly better valuation. Both of these companies or these entities have the quality of having a much higher percentage of international traffic relative to total traffic, mostly because of tourism. With Pacifico, it having Cabo and some of the West Coast ones like Mazatlan and thing like that, and places like that, versus Sureste, which has the second busiest airport in Mexico, which is Cancun. So both of them had kind of like these crown jewel airports on either side, lots of international traffic, a lot of tourism related traffic. And that's important because the fees that airports in Mexico get to charge, the fees related to international flights are considerably higher than that for domestic. Central Norte for the longest time was the domestic flights business relative to like all their total flight. It was very, very domestic heavy. So that was the reason I was I kind of targeted more Sureste and Pacifico versus Centro Norte when I was doing my initial analysis. Now, some of the things that have changed since then, in particular, is that Centro Norte is starting to get a higher percentage of international traffic. So there could be some sort of like changing in valuation, changing in growth in that aspect for a couple of reasons. They're seeing more traffic. Number one, Mexico City is more or less at capacity, and they're really struggling to add flights. And with growth in the Mexican economy at a very robust rates, lots of business flights, for international trade related reasons. Mexico has free trade agreements with like 100 countries. And so we're seeing significant investments in manufacturing there. And so you're getting business trips and things like that. With Mexico City at capacity, some of that overflow is going to Centro Norte, in particular, Monterrey airport in kind of in the northeast of the country. So there is a case to be made that there is a growth lever for Centro Norte to pull that might be a little bit stronger than Pacifico and Sores, but I think at this time I'm still a little bit more in favor of the two tourism related airports for the simple fact that they already have that base of strong international traffic that's going to drive revenue for them for I see the considerable future. The biggest concern for all these is if the government does decide to stick its fingers into some of its operating agreements. The prior president, before the current one, Scheinbaum, Lopez Obrador, had talked about, making some, we'll call them just bombastic statements that so far haven't really translated into anything in terms of actual policy changes. But, when politicians say bombastic things about your industry, they tend to move markets pretty precipitously, and so it just kind of put that on everyone's radar that hey, maybe Mexican government intervention is not a completely unrealistic scenario.
Well, I saw a couple of questions in the queue. One specifically stands out from SB. Danny, I know you like Mercado Libre, ticker MELI. What are the key risks to the thesis that worry you, if any? Well, let's just go over what some of the risks are generally, and then I'll address which ones I pay most attention to. One of the things that you see called out a lot by bears for Mercado Libre is the economic environment in Latin America. Anybody who follows the countries in the region knows that there has been economic and political instability at times in Brazil. There has been hyperinflation in Argentina and in Venezuela. There have been some leaders that are approaching the economic situation in ways that some experts have questioned. So, there's always the potential for an economic meltdown in the region. Now, one thing I would say is that even while all this is happening, Mercado Libre is a company that handles online transactions. It handles online payments for customers who are making e-commerce purchases. And the way they set it up is that they get a cut of every transaction, albeit a small cut, but a cut nonetheless. So as long as people continue buying and selling and using digital payment methods to buy and sell, Mercado Libre is still going to be able to flourish in any environment. And we actually saw that over the past few years when the global economy was going through fits and starts, and meanwhile, Mercado Libre continued to do well. One of the other issues is that this is a company that's growing in several different directions at one time. The area that has been growing pretty well over the past couple of years has been their loan business. So what the company does is if you are a seller on their platform, if you are a vendor selling goods, Mercado Libre has your records, it knows your business, and it has sets up terms so that it can actually collect the money for you from you that you owe the company, and it can deposit right into an account and settle up that way. So there's not that much risk from a business standpoint. Now, it also lends money to consumers. And I think there's a little bit more risk there. They have a large book of business right now in consumer lending. I think if there ends up being trouble in the economy in Latin America or one of its larger markets in Latin America, then I think there could be a problem with um, being able to collect all of those loans. So I think that is probably one of the key risks that I follow. It is the leader in e-commerce in Latin America. It's the leader in digital payments in all of its largest markets. So I think the company has a really solid foundation. But if I would point out one risk that I think investors should keep an eye on, it's the loan business. It's getting to be a larger and larger part of what the company does, and any downturn in the economic situation could hit its results, at least in the short term.
Well, at least to give you a little bit of a vote of confidence on the loan book, I'm just looking at Mercado Libre's credit rating, and on October 31st last year, they actually got an upgrade to triple B minus. So I think they just got if I remember correctly, with Fitch, that makes it a investment grade rating. So
Mm-hmm.
perhaps not the biggest thing in that regard. I've been curious about the inflation related thing, especially in Brazil, because we saw like a 20% currency devaluation relative to the U.S. dollar this year, which obviously, most currency fluctuations over very long periods tend to come out in the wash. So, over 10, 15 years, these things tend to not be a huge issue. But over a 2, 3 year period, when you have large currency fluctuations like this, the reason that people would be bearish on that idea is basically you, as the investor, are looking to get paid in dollars. This is a company that takes all the revenue in a local currency, say in like for Brazil, for example. That I always mispronounce this one, but the reais. I think reais actually. Again, pronunciation's awful. If you see a currency devaluation that large, it just means that the company has to grow that much more for you to get equivalent growth on your U.S. dollar holdings in this company. So that's kind of the thing is, like, if you have enough currency devaluation in a major market like Brazil, it can basically, translate into maybe a slower growth or a decline. Not to say that that is a structural issue for the business over the long term, but certainly over a 2, 3 year period, you could see material weakness in a currency that is going to affect its earnings in the short term.
Yeah, I actually just looked up. Argentina has been one of the countries that has been affected by hyperinflation. And in 2023, its inflation rate was 211%, which was the highest in 32 years. And even in the midst of that hyperinflation, what Mercado Libre's management did was, as the inflation was ongoing, whenever they got, they built up reserves past a certain point, they were actually buying real assets. They were buying property in Argentina that they could hang on to, because the property wasn't losing its value as quickly as the money was. So I thought that was kind of a novel solution.
I can answer this one really quick because just doing a quick, screen of news. Ed asked just now, Celsius is up 13% today. Was there any news? And as far as I can tell, no. The last news story that I'm seeing, at least in the data provider that I have, says that the last news story was on February 10th, where Celsius settled some improper accounting practices claims for about $900,000. So I don't know. With a company like Celsius, especially with a company that's its stock has moved as, you know, violently might be an exaggeration of a word, but as much as it has, being down about 60% over the past 12 months, you're going to see big swings in any given day, and it might not even be on any news at all. And I think that may be the case with this big move in Celsius, unless there is some news story that I'm not seeing. And Danny, with that, that brings us
With
at the
that,
top of the hour. Maybe Celsius isn't exactly a tech and power topic, but you know what? We just kind of hit topics anyways. So we are going to be passing it off to Seth and Yasser for the next hour, where they're going to be talking chips, clouds, and more. And we'll be signing off. Danny, it was a good hour with you. And guys, take it away.
Thanks, Fools.
Thank
come on,
you.
guys.
Thank you.
Yasser and I, we used to talk every day. Now we work on different
know,
stuff.
now-
We never see each other anymore.
No, we have to go on the show in order to talk to each other.
Exactly.
So don't mind us, fools. We're just, Seth and I are going to be chatting for the next hour.
It's going to be very, very chatty. And in fact, there's a question on the queue here that was kind of interesting. It plays into a couple of the picks I have made in the AI services over the years. And I
Sure.
thought it'd be a fun one to start with, because it is, instead of chasing the hot ideas, this fool, Vihan, is saying, gentlemen, not to us.
Mhm.
That was to the prior gentleman. Who knows what he'd call us? What are your thoughts on Target and Walmart regarding valuation as AI plays? Is there an opportunity here that is being overlooked versus owning mega AI players of the big seven? Now, this is an interesting question. Right. I've been looking at companies like this for the AI service that I was running before AI became very popular and cool. People probably forget that 4 years ago, nobody wanted anything to do with AI. It was an AI winter. And Walmart stands out here as one of the more interesting ideas because if you can imagine trying to do logistics for Walmart, it takes an incredible amount of data to do that well. And Walmart has that data, and they've been using internal machine learning and other systems for a long time. And now they have more of an Amazon type service, consumer facing service that has built in sort of LLM tools and other buying tools and selling tools for their members. They have software that helps plan logistics that they also sell to other folks as a service. And of course, that's going to be AI, finger quotes, in some way or another, right? And any software you sell these days is going to be sold with the promise that it is somehow using AI, whether it is or not. Since it's Walmart and it's machine learning, I'm going to bet that that's actually true. So I think it's an interesting thought there that Walmart is actually a very, very technically capable company. However, the investment thesis for Walmart is by and large going to be driven entirely by those retail sales, because they just dwarf anything else that Walmart could do. Walmart is not going to be a cloud computing behemoth like Amazon became. It is going to remain primarily a low margin retailer. And so I'm just pulling up a Walmart quote right now as I babble, because I haven't looked at the valuation for a little while. Walmart is a company I used to not like very much. They did some stuff that wasn't very cool. I think they've cleaned up their act. I don't mind shopping there anymore for the most part as a consumer. And I'm looking here. What do we got for Walmart? Walmart is selling kind of close to all-time highs here. So at like a free cash flow yield of 1.9%, a very tame dividend yield, 0.8%. And, that top line growth is just a gentle upward curve. They sell a lot of stuff, $673 billion worth of revenue as of 10/24. That would be the trailing 12 months as of 10/24, producing at that same time almost 14 billion in free cash flow. So definitely a behemoth using AI to their advantage whenever they can, just like they used any tool they ever had to make lots of money despite those really thin margins. On the other hand, I don't think you can make the case at the current valuation that there's some kind of AI catalyst that would drive the stock.
Right. Well, I mean, if we look at the comparative valuation between Walmart and Target, we'll find that Walmart trades at multiples higher than where Target trades. And there could be legitimate questions as to why that might be the case. Perhaps it has proven more resilient in terms of its ability to continue expanding its store traffic, its same store sales, monetize its customers, basically. it has perhaps a bigger presence in the e-commerce space than Target does. So my wife is a big fan of the placing an order in Target and then going to pick it up from the parking lot, which was a COVID era invention that has stuck around, and thankfully so. It just saves a lot of time for a lot of people who want to order something on a short notice but don't want to wait for the delivery to come,
or in the lines.
God forbid, takes all 24 hours.
Yeah. And they understaff, Target
right.
understaffs the store near me. And so the lines are actually terrible. I think the key there to that, some of that valuation gap is also that Target has had a few more merchandising stumbles, sort of own goals, if you will.
Yes.
Over the past couple of quarters than Walmart has. They used to kind of stumble. Sometimes they stumble in the same quarter.
They built up their inventory way beyond what was needed. And I think that was kind of like a 2022, 2023 hangover from
Target
the COVID times.
Yeah, and Target is always a little more exposed to sort of a fashion risk, if you can say that. That the clothing section at Target tends to try to be a little more trendier than, say, the clothing section at Walmart. And Walmart has, of course, grocery as a very big backstop at a lot of its stores. Target has plenty of grocery at its stores, but not as much as Walmart has at its super centers. And that drives a certain kind of return.
And I would also say that Target might be a bit more exposed to economic cycles than Walmart. Walmart, sells at very, let's call them affordable prices, a lot of items. Whereas Target's perhaps a more premium clientele, maybe in the middle class.
Kind of a slight step up.
Exactly. And so that group of people can be fickle also in the sense that with any sign of consumer weakness or economic downturn, that group might decide to effectively, downgrade into a Walmart or a Costco or something like that, as opposed to shopping at Target and paying that premium. But I kind of wanted also to make a general comment here about this question, which is, how companies like this can benefit from AI. You're right that they're not going to become cloud computing behemoths. Definitely not anytime soon. But at the same time, you can try and think about some of the downstream impacts that AI might enable for companies, especially a company like Walmart that has just some of the most complex logistics in the whole world. Perhaps helps with inventory and merchandising, as you said, like with Target. Could that have been preventable with some AI model? I have no idea, but people who are bullish on AI tell us that AI can be smart about that sort of thing.
And again, that's the old school AI that wasn't This is not the LLM stuff, right?
No.
We want to differentiate for folks who are new to the AI game, that machine learning, where the systems were looking for patterns in the data that were maybe too subtle for humans to perceive, things that you would never have thought to ask, in records that have hundreds of thousands of rows and hundreds of thousands of columns. The machine learning could pull these things out, differentiated from the stuff we have now, which is computers pretending to be people talking to us.
Yeah. And our colleague Bill Mann used to say that some of the biggest beneficiaries of these large language models and AI and generative AI might in fact be consumer facing companies like a Walmart, where they can have, they can basically outsource a lot of their customer, interactions basically into AI.
Yeah. There's another one here on a couple of companies that you and I are more or less familiar with. The question today is what's going on with Synopsys. It's from Sadaf. And have you read the earnings today from Cadence? Because my guess is that the earnings from Cadence looked okay. But Cadence was also down. And so there's news on Cadence. I didn't see any news on Synopsys. They play in the same field. My guess is that something disappointed the Cadence investing crowd and that Synopsys is pin action. So we'll consider that one answered with probably a worry that came from Cadence. If anybody knows anything else, throw it up in the question queue. I was in too many meetings this morning. I couldn't read all the
Sure.
earnings I wanted to.
Yeah.
But I did notice that they were both down. They tend to move together.
And synchrony, yeah. So Synopsys has not reported yet this quarter. However, Cadence Design System, which is, so imagine this electronic design automation system, basically companies that help design chips
that we use.
Right, the chips that we use. It's an oligopoly. It's a market dominated by effectively 3 companies: Cadence Design Systems, Synopsys, which is the biggest, and Siemens, I believe. Yeah, Siemens is the third.
And Amazon trying to elbow their way in a few spots, but we won't talk about that right now.
Not right now. Yeah, but yeah, it's a pretty, it's an oligopoly. And so obviously when Cadence says that they're seeing softness ahead, and a lot of the weakness today has to do with an outlook that did not necessarily meet I think the street expectations. I think that tends to have knock-on effects, obviously, to Synopsys, which is its direct rival. But people expect that this is going to be the case across the board. I think Cadence specifically warned on China revenue, and I think some of the sanctions and restrictions that have been placed by Washington on a lot of chip companies in terms of what they can or cannot export to the Chinese market is starting to hit some of the U.S. or Western-based chip manufacturers, and in this case EDA maker, and starting to come through in the numbers. And we've seen that before with ASML as well, saying that they, it is a big chunk of money that they're leaving on the table.
Yeah, I'm just looking at through the earnings from my older robot articles, which I made again back before LLMs were cool. I had Excel spreadsheets write Word articles on earnings using the verified numbers, so the math errors could be squashed. And it looks like Cadence barely hopped over the bar on revenues. It was still 27% growth over the prior year quarter at 1.36 billion. But if expectations were 1.35 billion, getting 1.36 is undershooting, right? And EPS looked all right. The non-GAAP EPS, which we'll use because who knows what they're baking in the analysts tend to use a non-GAAP figure, were 36% higher, and also beat expectations. Margins were kind of, gross margin and net margin were down a little bit. And then I think, maybe the bottom here where I look at the estimates, these estimates, if they came through before the estimates were changed by the analysts themselves, it looks like the mid-range of what Cadence guided to was a little bit lower than the consensus mid-range. And so that these days close is a miss, right? So I think a lot of it has to do with the guidance, to be honest. I think the quarterly results were fine. They basically issued slightly lower revenue guidance of about 11.6% year-over-year growth for the year versus consensus of 12.8% growth. So they missed by 1.2 percentage points, and that can be significant for the market. I see a good one here that'll get the two of us blabbing for far too long. From SB, home builders are under pressure due to high rates and costs, but long-term fundamentals seem okay. What's a good strategy to gain exposure for max return? We'll leave the last part out since we don't want to give anything that sounds like personalized advice. But Yasser and I have both recommended home builders and related companies in trends. And I was actually working on this a little yesterday. I was needling the National Association of Home Builders in person over email. Can you do that in person over email? Because I was reading the builder sentiment numbers, and they're down. This should not be a surprise because new home sales weren't bad last month, but the climate is beginning to get kind of scary. And we've got threats of 25% tariffs, which would cover softwoods from Canada, which is about a fifth of the lumber that comes into the U.S., but it raises lumber prices here as well, right?
Yes.
When the external prices are higher, and my gypsum wallboard, which can come from Mexico, would also increase in price, which would increase prices everywhere. And I was actually needling them because they were complaining about it with the prior administration and not complaining about it with the current administration. Oh, and I thought that was an interesting shift to not say, can we please not have tariffs? But this is a major concern if your home builders and the prices are already big. And of course, the mortgage rates are high. And so this has led to the unaffordability problem that you and I have been hoping there'd be some steps toward resolution over the past couple of years, and there haven't been. And some of these are own goals. The home builders continue to, for the most part, well, maybe mention a couple of exceptions, build houses that are so big that they have to be really expensive and people can't afford them.
Yeah.
I'll throw out one more number before I throw it to you. I read maybe a month and a half ago, that we are at a record in the US for number of spare bedrooms per household. People have like 1.75 spare bedrooms per house.
I don't even know what to do with that. I mean,
everybody's got more house than they need, but nobody wants to budge. And we keep building more house than we need, right?
You know what? That does not surprise me at all. We have a proclivity in America to live large. So that, look, I think that the housing market in general, from a fundamental perspective, we are underbuilt for our need. We have, depending on who you read, we may be underbuilt by 1.5 million homes to around 3 million homes. That's a lot of unmet demand. Problem, of course, is that a lot of that demand is for, affordable homes. It's not for the luxury 5-bedroom, big yard kind of house that a lot of the home builders you mentioned tend to make, because those tend to be the most profitable. So how do you meet that demand? The other issue is that our housing market has been essentially frozen since COVID. The lucky people like myself were able to either to refinance, or people bought homes during that time at very low mortgage rates, and they're extremely reluctant, and for good reason, to give up those mortgages and trade them for something else. So that has created almost a situation where people are just not selling their homes, and therefore are not looking for new homes, or so it's basically has been a frozen existing home market. Home builders have actually navigated that rather well. And some better than others, and we may get back to which companies we like in that sector. But ultimately, I think you're absolutely right to note that there might be a perfect storm here, in that costs are rising. So you have a lot of, basically, labor is in shortage. People who will actually do the job of building the homes. And then you have, obviously, the threat of tariffs might increase the cost for raw materials of those,
and appliances and furniture.
Right, exactly. So everything across the board could cost more. And then you also have, more importantly, you have historically high, or not historically high, but high compared to at least the past,
high compared to the last 5 years ago.
Right.
From my first mortgage, these mortgages are still a bargain compared to the first one I took out.
True.
But
yeah, I remember my late father-in-law is talking about how he was able to sell 18% mortgages in California in the 80s.
I remember those.
But yeah, I mean, it's incredible. So we have higher mortgages than what we are accustomed to, and that's already coming on the back heel of very high home prices. So it's just an affordability crisis across the board, and that can hurt, including home builders are going to suffer from that. But I don't know if you wanted to talk about like which companies within the sector might do better
I don't
than
have all
others?
their
Or
latest earnings like right at my fingertips, and I forget
right.
which ones I own. But so this will, if you knew me in
Yeah.
2007 or 8, you'd go,
Yeah.
you'll never buy a home builder, because I was
Sure.
just railing against this like giant financial fraud that had been kind of created by the home building bubble.
Right.
But the home builders really cleaned up their act enormously since then.
Yeah.
And so a couple of years ago, you and I started to get more interested in them.
Mhm.
And we made some recommendations, and I
Almost
bought a
3
bunch
years ago.
myself. Yeah. And so
Yeah.
I'm trying to remember which ones I own. I think I own Meritage. I think I've owned,
Mhm.
been in and out of several.
S-
Almost all
Yeah.
of them look pretty good to me right now. If I were approaching this as somebody who has no home builders at all, I would probably kind of buy someone down toward the low end, like a KB, and then maybe one in the middle and one further
Right.
up. And then I'd also look
Yeah.
for companies that are servicing the supply markets and those as well. And these are going to need to be
Yeah.
long-term holds for anyone
Right.
who's interested, because there's no quick fix on the horizon here. Mortgage rates, I don't think, are going to go down, even if
Right.
the Fed cuts, which I don't think is going to happen. The 10-year
Yeah.
treasuries have stayed buoyant because the bondholders are freaking out that that they're not going to get paid their interest possibly, and we
Right.
haven't even gotten into the fights over government shutdowns yet. We get any threats of that, and the 10 years are going to probably go crazy again. And mortgages are not based on Fed rates. They're based on 10-year treasuries. Everyone should remember, and 10-year treasuries don't always follow Fed rates moves very closely. And
Right.
when things are crazy, maybe not at all. So we're probably not going to get much daylight there. That said,
Do you think we need a housing crisis before we can have a rebound?
see, that's the problem, is that
And by housing crisis,
people who,
I mean a downturn for the housing market, like prices falling 10-20% on
and
existing homes.
yeah, I can't see that happening in the current conditions, because as soon as prices move a little bit, people start snapping them up, or deep pocketed equity buyers with cash start snapping them up.
Right.
So this really demands, in my opinion, a lot of ways, a government-led plan of some kind
Right.
to provide benefits to get more smaller homes built for first-time buyers, incentives of some kind to get people who are living in a house with 2.5 spare bedrooms to trade down somewhere else. I don't see anything changing over the next couple of years unless something like that happens. But I still think the home builders can do okay in that
Right.
climate. Although I wish that climate were different.
Right. I see a question from Sadaf asking, "What is your take on Taiwan Semiconductor potential stake at Intel Corporation's foundry? Is it a short-term bad news for ASML?" The short answer is no. ASML does something that nobody else does. They have their extreme ultraviolet lithography machines, which are able to effectively manufacture chips smaller than 5 nanometers long. With the latest iteration of those machines, they call them high NA, making sub 2 nanometer chips. So they basically have a monopoly over that segment of the business. So foundries like Intel, Taiwan Semi are both customers of ASML. They buy the ASML machines to build their foundries, and then use them to kind of sell or make those chips en masse. So Intel was actually one of the early customers of the latest generation high NA machines from ASML.
Yeah, Intel, in my opinion, Intel has done maybe the saddest thing is their marketing of their smaller node stuff, which they call it 18, which is dumb because it actually, compared to, now these are all sort of like, this is jargon that goes back to nanometers or angstroms at this point, but 18 in Intel's verbiage is actually equal to 1.8 in in Taiwan Semiconductors, but it makes it sound like it's like 15 generations old. It makes it sound like 18 nanometer or something, like the kind of thing that is, put in like crummy car stereos or something these days. But it's not. My take on, I think I agree with you that if Taiwan was buying a stake in Intel's foundries, it wouldn't matter at all, because you can't run either foundry with fewer ASML machines. You need those machines if you're going to produce high-end chips at any foundry. But I also don't think there's a chance in heck that Taiwan Semiconductor is going to have anything to do with Intel's foundry business. Why would they? They don't need to, unless there was some weird government threat to bar imports from their plants, unless they rescued Intel's foundry business.
Right.
I don't see why they would do it. In fact, I think they already sort of shook their head and said, no, we don't really know what you're talking about. What are you people smoking over there in America?
Yeah. Yep. I don't know if you see another question you want to take, or should I keep going?
Yeah, if you see one, that was my take on Ed's question. Oh, no, on Sadaf's question there. Yeah.
Okay. All right. I see a question from Amar 53 minutes ago. Wix.com versus Shopify. What do you think? Okay. So, I'm much more familiar with Shopify than I am with Wix. So please take anything I say here with a grain of salt. I would say, Shopify is basically the real deal. Wix.com is kind of a competitor to what Shopify does, which is to enable merchants of all sizes. They started out with small merchants, but if increasingly they have gone up the ladder to large enterprises recently, and they've been very successful with that. But Shopify has effectively created that space. It has almost a near complete ecosystem of all the functions and options and features that a merchant needs in order to run a business virtually or online, and without having to open a physical store, so to speak, without having to get specialized accounting software or special marketing tools or special this and that. Shopify acts as a platform. It's not just one thing you subscribe to, but you actually have a whole ecosystem of accounting software and marketing software and this and that allows you to run virtually all aspects of your business pretty efficiently. I think Wix tries to compete with that, but again, the gap is pretty large, and Shopify is multitudes larger than Wix. And that's reflected also in the financials, in terms of revenues, earnings, and so on. Of course, the valuation Wix is cheaper, but you have to ask why. It's a much smaller company that's growing far less than Shopify is. So I think that should also not be missed on any investor who's interested in investing in that space.
Yeah, I agree with you there on all of those. I scrolled down a little further. I see a message here from an hour ago from Vihan saying, gentlemen, thoughts on Altair Engineering at current valuations. I know this company a little bit. It was a recommendation of mine a while ago that was sold from the service, not because it's not a good company. I think they are a pretty interesting company that does some amazing things. If for folks who aren't familiar out there with Altair Engineering, their business, the core business was providing mathematical solvers so that when you're doing simulations that really matter, for instance, you're making a car or an airplane, and you have to simulate exactly how items might twist or bend or crash or just operate under normal conditions, that's incredibly complex math, and you need sets of solvers and software that can model this very precisely, or you don't get anything. So one of the reasons I used to laugh at like Zuckerberg or Jensen Huang when they said, "Oh, we're going to have these these virtual reality places where everybody will just be able to design cars and things," and they looked like low resolution Nintendo stuff, and people bought this, and I was just shaking my head, because if you were familiar with the kind of software this actually takes to do the job, you'd know it's not possible to have that inside of a game-looking web browser. But anyway, that's the kind of stuff Altair does. That was its core business. It expanded out into a lot more AI and sort of cloud services. And good company, trading near all-time highs, up since I recommended the sell, of course, because that's always how it goes. However, a lot of their business is the auto industry and other industrials, which could be under some major stress if we see this tariff war, which we're having promised very soon. And they'll also be, those companies will also be under stress, even if there aren't automotive specific tariffs, because steel and aluminum, most of which we import in this country, are slated to go up by 25% as well. And so I anticipate problems at those companies, and I anticipate them to watch their other spend carefully. And that other spend would include stuff like the services that Altair provides. I like Altair, but it's sort of a slow top line grower. We're a little bit under 10%, and decent free cash flow. Most recently, like an 18.5% free cash flow margin, which is pretty amazing. Historically, closer to like tens or mid-teens. But trading right now for a free cash flow yield of about 1.4%, while growing at like 7 to 8% on the top line, to me, that's not really a compelling investment, especially if I'm worried that the end customers are going to be getting hammered by a trade war, or even if they're not, they're getting hammered by the uncertainty of whipsawing promises of a trade war.
Right. Yeah. Revenue growth of 8% with a free cash flow yield at 1.4% doesn't really sound like an investment that I'm gonna like, oh my god, I can't wait to get there.
And let's put it in terms that people might understand better.
Yeah.
Like, what if we were trying to sell them a car wash, right? If Yasser and I were like, hey, Fred, we have a car wash for you. You're gonna love it. It's gonna grow. The top line's gonna grow 8 or 10% a year, and you have to pay us 50 times what it currently makes in free cash flow. You'd look at us and you'd say, you're crazy. I'm not waiting 50 years to get payback or whatever it is with the growth.
Right.
I'm not waiting that long to get payback on my cash. You can do that for these stocks, and you should do that, especially if they are long established companies like Altair and they have
mature companies. Yes.
Mature companies with sort of slow, predictable growth. You need to pay much more attention to that than a company that may be doing the hockey stick.
Absolutely. All right, so we have a good question here from Ed. He's asking, do you think taking an initial investment in some of Motley Fool blue chip companies that go down after earnings is a good way to build part of your portfolio? Trade Desk, Wingstop, ASML. Right. I think that's a good question. I don't know that I agree that these are so-called blue chip companies. I think maybe they are, blue chip for us, as in they're widely recommended, widely held by Motley Fool services, whereas traditionally blue chip company might have a different meaning, as in more mature company that with very predictable earnings and so on. So I don't know, Seth, do you want to take a crack at it?
So we want to avoid saying anything that sounds like a personal investing advice, of course.
Exactly.
But in general, Yasser and I are both kind of cheapskates, and we probably both agree. I'll put words in his mouth that all other things being equal, we'd much rather buy a company when the price is lower. We might buy that car wash at 5 times free cash flow, or 8 times free cash flow, the one that we wouldn't buy at 50. And so some of these companies on this list I happen to be more familiar with than others. One is Wingstop, which I was in and out of for years before it had its huge recent run. And I actually, looks like I got out somewhere near the recent top, which is unusual for me. If I sell something, it tends to keep going up. I just looked at the valuation a while ago, and I said, this just looks too rich for me. They're doing great. They're growing sales. I like the product myself. I could see that they were expanding their footprint in ways that they had not in the past. In other words, The stores used to be spaced. There used to be a much bigger space bubble around them. I used to have to drive to Springfield for my Wingstop. Now I can go down the street to Annandale to get it if I want. And they had generated a lot of free cash flow over the years, but that free cash flow is pretty lumpy. I'm looking at my graph and it basically kind of does, it sort of does this. It's a zigzag. It looks like a saw blade. And so, you know, some years 17% free cash flow margins, some years like 5%. We're in one of those down troughs right now.
Right.
Is it a buy right now? To me, boy, I see a free cash flow yield of 0 on my spreadsheets of the trailing 12 months. So I would have to dig in here and see what exactly is going on. This franchise model should, in my opinion, always be producing some cash. So maybe I have a data issue. Maybe I need to dig into it more, but it's not one I would look at and just say immediately like, oh yeah, this is so cheap. I've got to ring the buy bell or whatever, you know, buzzer. The
Right.
guy on CNBC has, although it's up a little over the past month from like $270 back up to, you know, over 304. So there's some support for that.
No, it's down big today after earnings.
Oh, it's down today. I'm not seeing
yeah,
it today.
yeah.
So we were at a
Right.
PE of 72. What's the drop today? I'm not seeing that on this sheet.
Yeah, I think it. Let me just.
If it's down 50%, I'm gonna have to stop talking about it. It won't be.
It's not down 50%. It's down 14%.
Yeah, to me that's still there. One of our studio guys used to. His dad was a good investor, and this advice saved me more than once. And it was always the first bad news isn't always the last bad news. There's no hurry to catch that falling knife. In other words, you can wait and watch for a couple of quarters.
Right.
I think it makes sense to be selective, but a 15% price adjustment doesn't always come out to buy.
Yeah, sometimes it pays off to be patient. You know, like a day like today, and I'm not saying this is going to happen. I'm just saying I've seen this happen before, that you would have a big drop after earnings, then maybe a couple of days of moving sideways, then analyst downgrades start coming in, and then you have further weakness on the stock before things stabilize again. So, you know, don't rush into anything. But the most important point for me is that you have to build conviction in the companies that you invest in. So if I think that Wingstop is a high quality growth company, which I believe it is, if I believe the same about the Trade Desk or ASML, etc., which I believe they are for the most part, I will, you know, every once in a while take advantage of a stock that has been punished for whatever reason. If the reason is fundamental to the business, that is, if the business is showing signs of problems, either with management or with accounting or with, you know, like missing the boat on important trends in the industry, things like that, I will back off. But if, you know, missing sales by a couple $1 million, or having 15% expected forward growth as opposed to 16% or 17%, you know, that's fine. I can live with that. I want to make sure that I'm getting a good price. I want to make sure I'm getting a good valuation. Some of these, especially high quality companies, will always trade at a premium, or will tend to trade at a premium to competitors. So don't expect that they'll necessarily become dirt cheap and a value investment. But yeah, so dollar cost average can be a good method here. You know, just think about when you want to buy and build your position over time, so you're not all in at once, and therefore you can kind of mitigate any risk associated with that.
Yeah, and it's it costs nothing to buy a stock now, like literally 0 in transaction fees. So sometimes I use a stock purchase as like a post-it note on my desk. Buy $100 worth of shares to remind you to look at it later. And if it pops up in your portfolio and it's down, you'll go, oh, what's going on? Oh, I didn't lose much. Or maybe it's a better opportunity now. Or, hey, it's up. Boy, I guess I should have paid more attention. You can learn some things with, about the cost that it might take you to just scribble it out on a Post-it note.
Okay. Question from Sadav. How do you rank home builder, REITs, mortgage and mortgage finance industry? What are your favorite companies in those industries? I don't know that I would rank them. I think these are three important industries in their own right: home builders, REITs, real estate investment trust, that is, and then the mortgage finance industry. In terms of favorites, I think we mentioned KB Home for me is one of my favorite home builders. REITs, let's see, maybe Prologis is probably a safe bet in that space. It's the biggest kind of industrial and e-commerce REIT. They have a lot of very valuable real estate, and they're very well managed. Mortgage finance, I have no idea.
Yasser and I only dabble in lenders when there's panic and a lot of money for us to lose, or very little potentially gain. The problem with either mortgage finance or just any kind of banking is you don't know what the credit quality is like. No matter how good you are at reading all the filings, you really don't know. And that stuff never becomes clear until there's a big problem, at which point standing up and screaming, hey, actually, their stuff here is pretty good. And look, it's all in this section of the market, which is still paying its rent, isn't going to do you any good, because you will have been flattened like Kevin Bacon in the sidewalk during the last scene of Animal House by everybody else scrambling for the exits.
I was burned pretty bad. I think this is what you're referring to, Seth, with First Republic Bank. I mean, looking at the books, looking at things, it seemed like a reasonable bet to make that they will survive. But ultimately, having a run on the bank, that will end, So anyway, we tend for the most part to, or I tend for the most part to stay away from financials, just because they can be pretty complicated. I will be the first to admit I'm not the most experienced when it comes at looking at the books of any bank.
Yeah, and I think we're spoiled here in terms of REITs. We can rely on Maddie Argersinger,
definitely,
and Ant to find good prospects for us there. And so I own a few that they've recommended over a while. But these are all very different kinds of investments that fit very different kinds of needs for your portfolio. So it's kind of an apples to oranges comparison question there.
Right. Okay. Foolish Skeptic asks, Seth and Yasser, what ticker symbol and percentage is your largest stock holding?
Yeah, that I won't answer.
Too personal?
Yeah. No need.
TMI.
No need.
Yeah. Okay.
If you want to, go ahead.
I'll take it. I would say my largest position is Shopify, and that is not because I set it out to be such, but because it has grown to be such. I first bought Shopify in 2014. And I believe at a post adjustment cost basis of around $2.68, something like that. So it has done a lot of the heavy lifting itself. I have tried to stay away from, quote unquote, rebalancing my portfolio by selling early, or selling after it had 5x or 6x or 10x. I like to follow David Gardner's advice in that respect, is to let your winners win and run and all of that. And that is advice that has served me well over the years. And I'm frankly grateful that I did not listen to a lot of the kind of Wall Street orthodoxy of like the need to sell your winners and double down on your losers in order to balance your portfolio.
Yeah, that's
But
definitely no good. But I can
yeah,
I can think of
Mhm.
companies I had that went to 5x and then went to 0.5x.
definitely,
Yeah.
yeah, there are definitely lots
That
of
happens
examples
too.
of those. Yeah, that happens
I think
too.
for the
Yeah,
most part, though, most folks, depending on how they invest, but if you're investing in the kind of stocks that tend to appear in our services here, your biggest holdings are going to be ones that you did not expect necessarily to be your biggest holdings.
right.
And you read the write-ups. Every one of these growth stocks, we're all like, "Hey, this could be this huge someday." And once in a while, that happens, and that's how your $4,000 can turn into $400,000 if you manage not to sell any. We also get an assist in that here, in that we can't, if we have a recommendation out on a company, we can't really sell it without saying like, okay, it's just gotten to be too big a piece of my portfolio. So you got to get a clearance from legal, and then you have to tell members, hey, I'm going to sell some of this even though I like the company because it's just overweight for me. And that all is kind of a hassle and a whole thing. So it has also happened that I have been lucky enough to have really not been able to sell things that grew into enormous winners that I otherwise may have sold somewhere along the way, just because it was going to be a hassle, because it was also a recommendation of a service that I was working in. So that can also happen. Yeah, generally, when you invest in the kind of companies that are recommended by our services, I kind of go equal weight into most of them. Over the years, I have learned that the one I may be most excited about maybe isn't the best idea. And so this is a way of kind of handicapping your own, what's the word I'm looking for? Overconfidence.
Hmm.
And, the winners often surprise you.
Yeah, absolutely.
There, Sherry has a question about
Mhm.
Arista Networks positive earnings report, but stock is tanking. My feed on one of our things says that it's up 1% today. I don't know what the latest quote is. I should probably just look at a NASDAQ or something. Anyone have the latest
Yeah,
quote?
I have it. Hold on. It's down 7.5%.
Oh, well, great. So
Huh.
the thing the investment intelligence platform we pay a bunch of money for has a, I don't know, is that yesterday's quote?
Yeah, they
Okay,
they have quotes from yesterday. The close of yesterday. Yeah.
No, I've had for set for daily stuff. I gotta holler at them again. That's getting old. I wouldn't call that tanking. 7%. Arista is selling like hotcakes in terms of the multiples it's getting.
Yeah.
I went through that call pretty carefully today.
I mean, it's still up 58.5% over the past year. So
Yeah, I mean,
even
so
with the
it's hard.
7%.
Yeah, it's hard to go like,
Yeah.
oh my God, it's
Yeah.
down 7% today. But that's a funny bit of human psychology. It's like every bit of upside we earned by being so clever, right? But
Right.
if it's gone the other way, then there must be something that's not great going on. One of the Bill Barker always used to say, if somebody asked a question about a stock moving, he would always just answer because it's a stock. But I went through their earnings today. Maybe they were light on the guide. I haven't read any other articles yet.
No,
The
not
guide looked
even that.
fine to me. It looked to me it looked like it matched or slightly exceeded.
Yeah.
And
So
everything looked
they had an
fine.
initial guidance of 15 to 17% revenue growth for 2025. They came and said, actually, forget that. We're gonna stick with
Oh, that's right. They raised it slightly.
17%.
Yeah.
17%. So
So
they
they went
said
back.
the
They went to
upper
the
side
high
of the
end.
range, high end of the range. And the market was like, what? You didn't raise it even further? Well, we're gonna sell you off.
Yeah. So this is one that is, again, this is one where I can't even remember if I own it or if I just recommend it. I know I have it in services, but I can't remember if I bought any of it. Sometimes that is the tragedy. I believe I also own it. I would have to look at my holdings. Arista Networks earns a 48%. Well, this is before yesterday. A 48% free cash flow yield, mostly selling hardware. There's only one company out there selling computer hardware that's higher than that. And you all can guess which one that is.
Does it also start with an A?
No.
No. N.
Starts with an N.
Yes.
And And they compete a little bit on some of the spine, or not the spine, the leaf and spine stuff. They compete in the leaf, according to Jay Shree, if I can understand what she's saying. Arista is not an easy company to follow if you're trying to dig into the tech. So I mostly just try to get a basic understanding of the tech and then look at the financials. And they just continue to outperform and have for a while. So I'm not worried at all by anything I saw in there. I'm especially not worried in light of what the hyperscalers, and now they've got Oracle among them. Well, they call them cloud and AI titans. They're all planning to just spend a gazillion dollars on more AI data centers. And don't forget that the normal kind of data center growth is still continuing. People are still buying plenty of CPU power. It's just growing at like 6% a year, which next to the GPU sales looks like nothing, but it's not nothing. And so all of this needs high-speed linkages. The AI stuff, if you read the calls and listen to what Arista is telling us, takes specialized software to run the hardware, to navigate the different kinds of traffic demanded, because it's not the same thing as just serving CPU crunched data over that the hyperscalers were doing in the past. And so they're actually developing like future technologies, and they're looking forward to past 800 gig to like 1.6, whatever the next thing is. And they're developing some of that with some of their biggest customers. And so I don't see that slowing down. My only worry ever with them is the price. And if they actually come in light one of these days, which they didn't do, but if they actually do come in light, the stock is just going to get pummeled. But the company continues to do an amazing job. They produce so much free cash flow. It's insane. Their capital spending is almost nothing. Next year, it's going to be bigger than usual. They usually spend like 30 million, and they're going to spend 100 million, they said, next year, because they're building out their HQ. But if you went through and saw anything differently than I did, speak up now, because it all looked great to me.
Yeah. Of course, I always get nervous when I see a company talking about building a new HQ.
I think they were just saying they're adding on to it.
Okay.
If I remember it correctly. Yeah.
Yeah.
I was frankly, I couldn't believe that was their capital spend, that their normal capital spend was like 30 million.
Right.
I had never looked at it in particular before, and I went, wait, they make $3 billion in operating cash flow, and they're going to spend 30 billion on CapEx? Like, they should be doing money baths or something back at the headquarters. They are still doing buybacks. And they've got like almost $1 billion left to buy back on their current plan.
Okay. Yeah. AB Fool is asking, hi Yasser, are you still bullish on LaserTech Corporation, ticker symbol LSRCY? The short answer is yes, I am. Just to introduce this company to the audience that may not be as familiar with it, it's a mid-cap Japanese semiconductor equipment company that specializes in making inspection and measurement machines for chips that are made using ASML's proprietary kind of extreme ultraviolet lithography machine. So I don't know, this was a mouthful, but LaserTech basically, which was a company started out in the 1960s, focusing on making optical optical engineering equipment, including microscopes, and then moved on to testing and measuring flat panel displays. Eventually realized that its technology can, in fact, very accurately measure and inspect extremely small things, including ASML's EUV chips. And so they have basically repurposed some of that technology towards building machines that are able to kind of accomplish that task. So it becomes almost a necessary part of the life cycle of making a chip in terms of quality control. So you want to make sure that the masks, which are basically the wafers and so on, that have all these chips embedded on them, that they don't have even a minute or a teeny tiny scratch that might affect the performance of everything. You want to make sure that the patterning on those chips was done accurately and correctly. So if you want to have that process of quality control, then you pretty much have to buy the Lasertec machines. They have experienced incredible growth over the past 5+ years on the back of that, of effectively being the only game in town. They're still, for the most part, the only game in town. However, the weak forecast from ASML has kind of caused investors to become extremely jittery about Lasertec, and that has caused a huge sell-off on the shares. But nothing, again, fundamentally is threatening the business. Business is still profitable, still growing, growing pretty fast too. They are conservative with their 2025 guidance, but they are still projecting growth. They have been insanely profitable, and if you look at the return on invested capital, return on equity, all of these measures, just incredible. Like we're talking 40, 50, 60% here, year in and year out. So that's a company that I think should be at least a long-term winner.
All right. And I think I want to finish, if I can, with Scott Sodabear's question from a while ago. I'm triggered a little. You can see the vein throbbing in my head. Any thoughts on emerging power and computing space, including micro/nano nuclear, example, NNE, nanonuclear energy, alclo, and quantum, such as Qubit and Rigetti? I could not hate these companies any more than I do. These guys just give me terrible flashbacks to like the mid 2000s when I started working at the Motley Fool, and there was some new pretend hot tech happening all the time. These were the meme stocks of the time, and I believe these are currently meme stocks, if that's not clear by now. Start with the revenue. Like there's almost no revenue at any of these. Rigetti's got some, but it's very small, especially compared to the market cap. Giant losses. And the only big thing they have is promises. I don't believe those promises on quantum computing really whatsoever. If anyone's going to make quantum computing work, I believe it's going to spin out of somewhere like Google or even crusty old Honeywell companies, or IBM companies that have been working on it for a lot longer and have far more resources. And then the nuclear energy, like the small, some of this is small reactor stuff. Some of it is related. Some of it is we're going to do services. Unless you have revenues and a history of showing me how you're going to make money from this, I'm really not interested. Nuclear energy takes a long time to build. The big plants take forever to get permitted. And so now I guess Sam Altman has some companies. Alclo, the one he's involved with, I can't remember which one he's involved with. But they're saying, oh, we're going to have these small nuclear plants and we'll stick them on a data center. They're already proposing data centers that would require like 5 to 10 to 20 of these small modular plants that they want. They're talking about gigawatt data center campuses. That is the average size of an old school reactor in the US. Those things tend to be about a gigawatt in size. So these small nuclear reactors, these modular ones that you'll supposedly be able to either drive in on a truck or just drive the pieces in on a truck and put them together, they're still kind of science fiction. There are a few working towards getting done, but they ain't going to get done anytime soon, and certainly not fast enough to fill out this data center capacity. And in my opinion, this is way overblown. The data center power situation is a real problem right now. And ironically, the quickest way to get some of that power would probably be deploying batteries and renewables, because for a while I was saying like it has to be gas turbines. I still think it has to be gas turbines, but apparently there's a 4 to 5 year wait list for gas turbines right now. So even if you had a gas plant ready to go and everyone said we can hook it up, and yeah, sure, here's a permit, you don't have to do any paperwork, go ahead. You might have to wait that long to get the turbines to build things. And so I certainly think that those are going to be the way this heads long before nuclear does, especially since the small scale reactors, which seem very interesting to me, are not going to meet the needs of the data centers that are being promised by some of the folks, and in some cases Altman. He's on both sides of the trade. And that's my rant for the day.
Yeah, I have nothing more to add to that. Hi, Danny. Hi, Rachel.
Hi, guys.
Folks,
Thanks so much.
Well, hello, everyone.
All right. Peace out.
have a good hour.
Bye.
Thanks. All right. Welcome, fools, to another hour of Fool24. Danny and myself will be your co-hosts for this hour. We're going to be talking about the path to multi-baggers. This is our theme for the hour. If you have any questions around this theme, go ahead and get those in the Slido for Fool24. Event code there is Fool24. But also we see that there's quite a few questions that have already come in before. If there's any of those that we can answer specifically, we will do our best to get to those as well, and also answer any other questions that you drop in the chat, whether or not they are related to our theme. Danny, how are you doing today?
You know, I don't have anything to complain about. Life is good. Ergo my Fool handle, TMF, life is good.
Yeah, I think that also your description of Hawaiian shirt enthusiast is one of the best I've seen. That's my favorite. I need to come up with something much more exciting and creative on my side.
No, I have a reputation to live up to. And in fact, if you go back several years at the onset of the previous iteration of Fool24, I was renowned for my Hawaiian shirts. So I didn't want to let our viewers down.
This is very true. Well, today's theme is an interesting one. We talk about multi-baggers, and what does this mean? Essentially, when we talk about a multi-bagger stock, right, this is a company stock that returns more than 100% of its initial investment. And the term multi-bagger actually goes back to baseball, where bags or bases are used to measure the success of a play. The term was actually coined by Peter Lynch in his 1988 book, One Up on Wall Street. And the idea of you're investing in a business, you want it to deliver multi-bagger returns, you're hoping that it's going to deliver returns of more than 100%. And interestingly, in that book by Peter Lynch, he discussed various strategies for identifying stocks that could be multi-baggers. And I think different investors have their own approach to finding these types of businesses. One of the things that Lynch mentioned is you're looking for a stock that trades at a low rate but has the potential for higher returns. And obviously, there's a lot of reasons these types of stocks can be attractive to investors over the long run. There's a lot of different characteristics that multi-bagger stocks can be known for. Often you're looking for a business that appears undervalued relative to its peers and its broader long-term growth potential. It has strong fundamentals. You're often going to find these businesses in high growth industries, but you can also sometimes find them within more emerging markets. And, determining stocks that are undervalued relative to their fundamentals and their long-term growth trajectory, there's a lot of things we look for, right? You're looking at a company's financials, their earnings and revenue trajectory, and what their pathway to growth in the future looks like. You're looking at a company's debt levels, for example, thinking about how scalable is the business, and that can require an assessment of a company's moat, their competitive advantages within the industry or industries in which they operate. And often these are companies that are consistently reporting increasing revenues. They're beating analyst estimate. They have strong underlying businesses. So sometimes we talk about companies that have had, tremendous run-ups in the market that may or may not be related to actual underlying strong business fundamentals. When you're looking for the long term, I'm also speaking about my own approach to my portfolio here, for businesses that have that multi-bagger potential. It's also so important to pay attention to, is there a business underpinning the stock? And ultimately approaching it from the mindset of, I'm investing as a part owner in this business, and here is why I think that it has the potential to deliver, these returns over the long run. But, Danny, I'm curious to hear your thoughts just on this theme and strategy.
When I was thinking back about some of my most successful investments, and there seems to be several common threads. One is that most of them are consumer facing. And along those lines, I'm talking about Netflix, which does streaming video for consumers. Mercado Libre, which is an e-commerce platform in Latin America. Tesla, which sells electric vehicles to consumers. Tickers NFLX, MELI, and TSLA. Some of the other things is that, these were companies that started out serving a market where that market previously didn't exist. There was no service to the market. When Netflix started its streaming video service, there was no such thing. It existed, but that no one had thought to use it as a consumer-facing service. If you look at, let's see here, Mercado Libre, they copied from the Amazon playbook. There was no e-commerce business, at least not one that was doing anything worthwhile in Latin America. Tesla virtually recreated the electrical vehicle market in the United States. When, if you go back, there hadn't been an electric vehicle in the country for 20, 30 years. So I think, when you look at a company that is consumer facing, a company that is serving a market that either is underserved or has no service whatsoever, I think those are two of the things that could potentially underpin multi-bagger stocks.
Yeah, it's interesting as you were talking about some of these companies. I was going through my portfolio thinking about some of the companies that I own that have been multi-baggers for me personally, and all of them are these really established, mature businesses that are very well known. Wasn't recreating the wheel and finding some small business that no one had ever heard of and experienced magical returns. So, for example, one is Eli Lilly. That stock is up more than 500% over the last 5 years. A huge piece of that has been in the last couple of years, especially given the excitement regarding its position within the GLP-1 drug space. But this is also just a broadly really well-established company with a really diverse portfolio of profitable drugs. Another one is Apple. That's up about 200% over the last 5 years. And I have been a long-term holder of those shares during that period. Amazon is up more than 100% over the last 5 years. So that fits into multi-bagger gains. Alphabet is another one that's up over 150%. And what's funny about this is when I started investing, and now that I'm further along in my investing journey, I evaluate a much broader range of companies for my portfolio. But when I first started out investing and I was building my initial basket of stocks, and I was thinking, I really want to buy shares of these companies, but am I too late to the game? Is it too late for me to buy in and experience growth from these types of businesses that everyone knows? These are the stocks that everyone talks about. How profitable is that going to be? And obviously we know, past performance isn't an indicator of future returns, but these have been really robust and innovative businesses through so many different economic cycles. And just as a newer investor myself, within the last 5 years, I have experienced, multi-bagger returns from each of these companies in my own portfolio. And that's also, been an exciting thing because it generates, more capital to reinvest or put to work. And, now I find that I've always been more interested in these growth-oriented businesses, but I find that the collection of perhaps more quote unquote boring stocks I've kept in my portfolio has given me the ability to look for some of these smaller, riskier businesses that fit into my risk tolerance because I have this underlying foundation of just really robust and solid businesses. I know we've got a bunch of questions that came in. I'm kind of just answered Vihan's question, which he was saying, Rachel, if possible, it'd be nice to hear the multi-baggers from your portfolio when you started your position, the stress you handled through its journey. Did you add any on the way up? So I was just talking about a handful of examples: Eli Lilly, Apple, Amazon, and Alphabet. And that has been a really exciting thing for me to see. Is as a newer investor, I was thinking about how these are also companies, particularly ones like Amazon and Alphabet that have also dealt with a lot of volatility the last few years. It hasn't always been an easy time to be an investor in these types of businesses, right? But my thesis regarding these companies, never changed. And so sometimes I would see that as, that could be an opportunity to add to shares, but I didn't trim, my portfolio positions in these really big businesses. And of course, I've invested in smaller stocks. I've invested in companies that, my thesis for buying them did not turn out to be correct. Teladoc is an example I've talked about a lot, right? Not every stock we buy is going to be a winner. But just this handful of examples of these companies, I think it's worth underscoring because, like I mentioned, for me, when I was a newer investor, I had this idea that I needed to somehow recreate the wheel and find something completely new and unknown to be able to grow a profitable portfolio. And I have found, based on my own interests, the kind of companies I like to invest in, and just my own general risk tolerance level, that I can, find opportunities in some of these smaller, more up and coming businesses that we talk about a lot here on the show. But these household names have also proven to be really great investments for me in the last 5 years since I started my investing journey. So that's been kind of an exciting experience. What are your thoughts, Danny?
I was thinking about your experience and some of the companies that you named, and that really ties back to one other aspect of multi-baggers. And yes, we've all heard the saying that previous results are not an indicator of future returns, and yet if you look at companies that consistently perform, they consistently execute on their business, they tend to continue. That's why one of the big things is let your winners run. When I go back and look at, for instance, the Magnificent Seven stocks, they became all the rage a couple of years back. And if you go back and look at them over the past 5 years, and for investors who may not be familiar with this acronym, it was come up by a Bank of America analyst who basically grouped together these companies that were all leaders in their industry, and that could all, benefit from the emergence of AI. Apple, ticker AAPL, Microsoft, ticker MSFT, Amazon, AMZN, Alphabet, ticker GOOGL, Meta Platforms, ticker META, NVIDIA, ticker NVDA, and Tesla, ticker TSLA. If you look at the 5-year chart, every single one of those stocks has gone up at least 100% or more. Now, Amazon is the laggard of the group. It's only up 109%, but NVIDIA is up 1,800%. And yet every one of these companies 5 years ago was already a mature company. They had already been around for a very long time. They had already proven that they were consistent winners, but a lot of investors avoided them because they thought, oh, well, I've already missed the train on that. That ship has already sailed, if you'll excuse the mixing of metaphors here. And yet what that shows you is that a lot of times there's a reason why a stock has gone up so much. There's a reason why these companies continue to perform, and it's because they're a leader in their industry, because they've cracked the code, because they manage their growth smartly, because they're careful with not overspending, and because they have really good management, generally speaking. So I think that can be a great part of how you identify multi-baggers. You not only identify small cap stocks that maybe you think can run, but I mean, all of these companies were very large cap stocks or even mega cap stocks 5 years ago, and they're all multi-baggers. This ties very nicely into a comment that Richard O made. He said, multi-baggers generally 10 to 20 years to develop patience is needed. You need to let your winners run. I completely agree with that sentiment. If you go back and look, they generally need years. You don't generally get a multi-bagger in a year's time. Now, we've seen some exceptions over the past couple of years. I'm talking about NVIDIA or Palantir or some of these other AI-centric stocks. But generally speaking, in the stocks that have grown the most in my portfolio are the ones that I've owned the longest. So if I go back to 2007 was when I bought Netflix. I bought Apple in 2008. I bought Chipotle in 2008. Intuitive Surgical and Mercado Libre, both in 2009. Chipotle is ticker CMG. Intuitive Surgical, ticker ISRG. Mercado Libre, ticker MELI. And some of these are still among my biggest winners. So Richardo's point is exactly on point, which is you have to be patient and you have to be able to withstand the ups and downs of the market. And a lot of that has to do with understanding that this is a long-term process, understanding that every one of these stocks we've talked about, go back and look at the charts, they have dropped 25%, 30%, 40%, 50%. But you look at the reason why the stock is falling. Is the stock falling because there's an overall downturn in the market? If that's the case, it's probably going to come back. Is it because the stock is dropping because the company failed to meet analysts' expectations? That's probably not a good reason to sell a stock. So I think it's important for investors to remember that it does take time, it does take patience, and it takes a certain level of calm within yourself as an investor. For me, I've gotten to the point where if I see a stock drop like the Trade Desk when it dropped 33% last week, the Trade Desk is already one of my largest positions. So I'm not going to go out and buy more right now. However, if I was still buying the Trade Desk, and this ties into a question that was actually from several days ago or actually a day ago from AI, who said after a few days calming down, are you buying the Trade Desk now? Well, I'm not necessarily buying the Trade Desk now, but if I was still adding to the Trade Desk position, I certainly would be adding. Now, to be fair, when I look at my holdings, the Trade Desk is already in my top my top 7 positions. It's my 7th largest position. It represents more than 4% of my portfolio. It's already doing the heavy lifting. I don't feel like I need to add to it, but I certainly would add to it if it was not already such a large part of my portfolio.
Yeah, I love those thoughts. We had a question that came in from Ed that I wanted to hit. Can the non-opioid drug from Vertex, short-term and potential long-term drug, propel this company to be a multi-bagger? I do, in my opinion, think this is one of multiple catalysts that could help the stock become a multi-bagger again, because it is worth noting over the last 10 years, Vertex has delivered a return of more than 300%. So this has been a multi-bagger before. Obviously, you're thinking about when you're looking at companies that have the potential to be a multi-bagger. Most investors are also thinking about a specific time frame in which they hope to achieve those kinds of returns. We talk about investing in companies for a minimum of 3 to 5 years, preferably longer. So even if you're looking at the stock over the last 5 years, it's been just shy of multi-bagger returns. It's delivered a total return of around 90%. And that movement for the stock has really been completely built around the company's continued financial growth, which has brought around a lot of enthusiasm from investors because of its portfolio of cystic fibrosis drugs. This has been where the company has built its foundation of incredible financial stability. They are the only company that makes drugs that are approved to treat the underlying causes of cystic fibrosis. It's worth noting another factor we talked about when evaluating evaluating multi-bagger stocks is looking at the company, looking at their management, looking at the company culture as well. There was a report from the business journals that said that Vertex actually grew their employee headcount 13% for the second straight year. And this is in a time where there are a lot of businesses that are being very moderate with their hiring. There are companies that have actually shaved down their workforce within the healthcare space. So it's worth noting that this is a company that is growing, not just financially and growing their portfolio of products, but also growing their workforce, which I think is a promising sign. Now, talking about their non-opioid drugs specifically, for anyone who's not familiar, this was just approved at the very end of January, and this represented a major change within the broader pain management market. It is the first oral non-opioid pain signal inhibitor. I'll explain what that is in a minute. And the first new class of pain medicine to be approved by the FDA in over 20 years. This was a big, big deal, right? So the drug is called Journevax, and it's approved currently by the FDA for the treatment of moderate to severe acute pain. So for example, you suffer an injury, you are dealing with post-surgical pain. This is something that could be prescribed to you. And it's designed to treat acute pain like that caused by a surgery or injury without having the risk of opioid addiction. And how it works is it blocks specific sodium channels within the peripheral nervous system that are responsible for transmitting pain signals to the brain. So it prevents these pain sensations from reaching the brain. It reduces your perception of pain, basically targeting the pain signal at its source before it hits the central nervous system, all without the use of opioids. I think that this is a significant potential long-term opportunity for the business. Bear in mind, this was just approved, so they're in the very early stages of what that commercialization journey will look like. They're also seeking approvals in other regions as well, not just within the US, but it's worth noting that they think their initial total addressable market is 80 million patients suffering from acute pain. So not only do you have the first in this new class of medicines, the first oral pain signal inhibitor ever, and also the first in a new class of pain medicines approved in 20 years with a broad total addressable market opportunity. And without the addictive potential of opioids, I think that is something that is going to be tremendous potential disruptor in the market. We obviously have to see what that launch is going to look like. At the time of their earnings call, they were only 10 days post their approval of this drug, which, as I mentioned, is the first selective oral non-opioid pain signal inhibitor. And so I would be watching for more updates on that in their next earnings call. 2025 is going to be a major year for their launch. They had already been building, their network pre-approval, working with national and regional payers, as well as group purchasing organizations to ensure greater access to Journevax once it was approved. So that's something that's notable. They have initially priced Journevax at $15.50 a pill, or $31 per day at the list price. So there's an opportunity there for it to be accessible for patients, potentially even regardless of what some of their payer options are, which I think is something that is also notable. But as I mentioned, they're working with payers broadly to ensure greater access for patients. They're also working with wholesalers to ensure that retail availability will start very, very soon. So this is an extensive addressable market opportunity. I think this could be a major factor in the company delivering multi-bagger returns again, because as I mentioned, they have before. But another one that I'm watching, which as I've mentioned, has a much slower rollout for the business, is the other major approval and launch that Vertex has been involved in. And this is their gene editing therapy, Cascavy, that they made or developed in partnership with CRISPR Therapeutics. Because it's a gene editing therapy, it is a very long process to administer, because it essentially involves extracting blood stem cells from the patient, editing them in a lab, so using the CRISPR technology to precisely edit the patient's own blood stem cells. And then the patient has to be prepped with a regimen of chemotherapy, and then they receive the infusion of the blood stem cells back. And Cascavy is approved for certain eligible patients who have either sickle cell disease or transfusion-dependent beta thalassemia. And the idea of Cascavy is to be a one-time functional cure that helps the patient produce more fetal hemoglobin, which is the lack thereof is what is the major factor in these two blood disorders. So again, given that it's roughly 8 weeks just to administer to one patient, the process is very long, and I think it'll be quite a while before we start to see the impact of Cascavy on Vertex's balance sheet. But that's another one I'm watching. And then there's its new triple combination therapy for what it's been known for. It's cystic fibrosis therapies, and this is expected to be another major blockbuster drug that potentially outpaces the potential of its current one, Trikafta. So I think these three recent launches and ongoing launches are going to be really key to the company's growth over the next 5, 6, 7 years and beyond.
So I noticed a couple of questions that have been in the queue for a few days that I just wanted to maybe knock out there. So this one is actually from Vihan, actually a day ago, and one that we've addressed a little bit that maybe we can maybe shine a little more light on. Oh, I just lost my question. Give me 1 second here. I'm going to pull that back up. So the question is, would love to hear stocks that doubled or tripled from your initial position and you had reinvested at a premium. Which stocks and how did you navigate price anchoring? I think that is a good question. And, you know, with many of the stocks that I invested in, I've talked about my process a little bit before, but just a quick recap. When I invested in a company and after the stock had gained about 40%, I would go back and revisit the investing thesis. I'd look at it and see whether or not the company was still performing, were they still doing what they needed to do, had the prospects changed any, and in some cases, look at the valuation, but not generally. And then I would invest another tranche of money into that particular stock. One that has come up numerous times in the past is Mercado Libre. That's a company that I invested in multiple times over the years. And sometimes I would invest in that stock even after it had gone up, but also because it was a company that I followed so well. And I realized over several years that there was consistency in what happened. And this is one of the things that happens when you follow a company for a number of years. Whenever Mercado Libre would disappoint, the stock would fall between 25 and 40% from its peak. And as long as it was for one of the reasons that I stated earlier, which is the market was disappointed or the broader market was falling as well, and it wasn't a company-specific problem, then I would, invest in the stock again. I would buy another position. But there are a number of stocks that I have bought and continued to buy when they were at a premium. Over the past several years, I started investing in NVIDIA, ticker NVDA, back in 2018. And I regularly added to that position over time. Every few months, I would add to my NVIDIA. And this is a stock that has never been cheap, certainly not over the past several years. I continued to add to it, and that turned out to be a solid position, a solid decision. Price anchoring, that's a tough nut to crack because it goes both ways. You look at a stock that you bought for, say, $100, and the stock is now down to $50, and you say, oh, well, I automatically want to add to that and buy on the dip. And that might or might not be a good decision. It depends on the situation. So you don't necessarily want to look at it and say, I want to buy this just because it went down, as I was talking about with Mercado Libre. You want to look at the situation. On the other hand, when you're buying a stock that is going up and going up and going up regularly, you can't say, oh, well, I bought this at $100. I'm not going to buy it now when it's at $200 because it's already doubled? Well, as we've seen with NVIDIA again, this is a case where if you continue to add when the company's opportunity continued to expand and you looked at the totality of the circumstances, this was a great opportunity. And even now, NVIDIA stock is only selling for about 30 times forward earnings. So even though NVIDIA stock has gained several 100% over the past few years, I think the opportunity is still compelling. And if it was not already one of my top 3 positions, I certainly would be investing in NVIDIA.
There was a question that had come in from Ed an hour ago about Wingstop. It said, Wing, your opinion, is it a good time to open up a position after the drop in price due to earnings? You think the slowdown in same-store sales is a concern? So this is not a stock I currently own. We talked about how we're not able to give personalized financial advice on the show, but I am happy to kind of talk about what are some of the factors that have been moving the stock recently, and some things I would be considering if I was looking at a position in this stock or adding to one. Broadly speaking, so as not to bury the lead, it was actually a pretty good financial report for Wingstop. They've been investing heavily in digital technology and other strategies that are designed to help the business really grow over the long run. Anyone who was following the stock might have seen that the company plunged to a 52-week low following their recent announcement, which in my opinion, given some of the numbers, seemed like a little bit of an overreaction. And I think it's also worth noting this is a company that, compared to the rest of many, exceptionally well over time. This has been a pretty high performer. Speaking of multi-baggers, it's up about 160% over the trailing 5-year period. It's been a robust investment. So in 2024, their same-store sales increased for the 21st year in a row, which is a really incredible track record. Their domestic comps, same-store sales, were up 10% year over year in the final quarter of the year. That seems to be a number that had bothered some investors and might be a bit of a move behind what's happening with the stock. That, to be clear, that's a pretty solid number, especially for a business at this level of its growth story. But investors had been, I think, expecting a higher number. But it's worth noting there were some other really great numbers across the board. So overall sales growth in the fourth quarter was 27% year over year. System-wide sales was 27% year over year. Domestic, as I mentioned, same-store sales were up 10% year over year. So a slower rate of growth, but still solid. Digital sales totaled 70% of system-wide sales within that 3-month period. Revenue from royalty, franchise fees, and other revenue sources, but primarily that comes from royalties and franchise fees, rose 31% year over year. Advertising revenue was up 30% year over year, and company-owned restaurant sales grew almost 15%. They had a roughly 26% operating margin, which is also a pretty solid figure, especially for this quick service restaurant category. And importantly, net income. The company was really profitable. Their net income for 2024 was $108.7 million. That was a 55% year over year increase. Their net income in the fourth quarter increased 42% year over year. These are fantastic numbers, in my opinion, for a business like this. I think looking at these figures and from what some of the analyst input has been since that time, I think investors were hoping for a slightly higher figure for their domestic same-store sales, which again was a 10% year-over-year increase, still solid, perhaps not what investors were expecting, but growth on every other metric was 25 to 50% higher year over year. So it was a really pretty solid financial report overall. And it's worth noting that the company is also planning to continue opening new locations in the year. They opened 349 net new restaurants last year. They're expecting to open another, I have to look for the exact number that they're targeting next year. but they're expecting a solid growth next year in that area. So in terms of their full year 2025 outlook, they're expecting their global units, so that was the figure I was looking for, to grow 14 to 15% year over year. So they're hoping to end 2025 with about 14 to 15% more restaurants than they did at the end of 2024. They're also projecting low to mid single digit domestic same-store sales growth. So that same-store sales growth figure domestically seems to be the sticky point for investors. They're projecting single-digit growth in that area next year. They delivered 10% growth in the final quarter of the year on that metric. It is worth noting, though, that domestic same-store sales increased 20% year over year in the entire year of 2024 compared to 2023. So, is this something that concerns me? Is this something that would impact my thesis, on the stock? I think that it's worth noting this has been a stock that has habitually traded higher to 52-week highs, closer to that level than to 52-week lows. I think the drop in price is something that we have seen with a lot of these kinds of companies that have a pretty solid Q4 and full year report, but maybe there's one or two metrics that investors didn't like. I think that's the case here. The biggest thing that sticks out to me from this report is they're expecting more moderated domestic same-store sales growth in 2025 in the single digits as compared to the double digits that they experienced in 2024. But they're still seeing solid growth rates, very profitable. Revenue is growing extensively. System-wide sales, so all of their sales from their various stores, is growing at an exponential rate. They're successively increasing their international presence. So for me, this wouldn't concern me if I didn't have, if I owned this stock and I didn't have, excessive, for my risk tolerance, exposure to it in my portfolio. Maybe I would consider taking a position. But, I think it's important to note something I've incorporated a lot into my investing thesis and that we talk about a lot is, not buying or selling on the news, so to speak. Sometimes we'll have stories that'll come out about a business and that might be something that warrants a look at an investing thesis about a company. But I never trade a stock based on one or two financial reports. For me, it's looking at trends and patterns over time. This is still a company that seems to me to be continuing to outpace their growth objectives on numerous fronts. Profitability is growing. The top line is growing. Yes, there's a bit of a moderation in their domestic same-store sales growth, but overall, they're still seeing tremendous growth from their both domestic and international cohort of restaurants. And I think that that's something that for me, when I'm looking at the stock, would continue to underscore my confidence in it over the long term. So something worth noting. I think it's important to not make buy or sell decisions based on a story or a single quarter or even a single report of earnings. But given how the stock has reacted compared to what the actual numbers bore out, I think that does not align. And I think that it was actually a pretty solid year overall. There was one more question that I had wanted to hit that had come in 3 hours ago from Richard O about Pfizer. He was saying, can you describe Pfizer's growth strategy and your confidence in it over the next 5 to 10 years? I'd be happy to give my thoughts on this one. Pfizer is something I've said recently on different shows. They're going through a period of transition, right? They had this exceptional era of growth during the pandemic. They entered into all of these long-term vaccine supply agreements with different governments around the world, raked in billions and billions of cash and profits. And inevitably, that growth was going to slow at some point, and it has, and that has impacted both the top and bottom lines for the business. Its growth strategy moving forward has been built very carefully through a series of moves that it made during and in the later days of the pandemic to really prime itself for future growth. And that was entering into a series of multi-billion-dollar acquisitions. One of the most notable was a biotech company that specializes in cancer treatments called Seagen. That was a $43 billion acquisition. but the deal brought 4 already approved cancer therapies into its portfolio. It really strengthened Pfizer's position within the broader cancer treatment market. It doubled Pfizer's oncology pipeline to 60 different programs. And that acquisition was a huge part of the company's plan to have 8 or more blockbuster cancer drugs on its in its portfolio by the early 2030s. Just that one acquisition alone is expected to contribute more than $10 billion in risk-adjusted revenues to its balance sheet by the year 2030, just that single one. But there were other notable acquisitions. One was of Biohaven Pharmaceuticals, which is most known for its migraine medication, Nurtec. This is a blockbuster drug that already has, I think, specific potential for Pfizer over the long run. And so these acquisitions were something that I think expanded Pfizer's oncology portfolio, but also their focus on other areas, immunology, neurology. And it's worth noting, Pfizer already had a portfolio of blockbuster drugs outside of its COVID-19 products beforehand. Even now, as growth from those COVID-19 products is slowing significantly, their growth is far outpacing pre-pandemic levels. Before the pandemic, single-digit year-over-year growth was really par for the course for this business. If you look at their full year 2024 revenues, if you exclude contributions from their COVID-19 products, revenue grew 12% year over year. They've got long-standing blockbusters in their portfolio like Ibrance, which is designed to help delay the progression of metastatic breast cancer. Another one is Eliquis, which is a blood clot treatment. They have their Vyndaqel and Vyndamax, I believe they're called, family of drugs. Nurtec, as I mentioned, which they acquired in their Biohaven acquisition. Sales of that drug alone were up 39% year over year in the fourth quarter of 2024. Management had previously said that they were planning to add roughly $25 billion to the top line by the early 2030s, thanks to the stream of acquisitions they entered into. And this is also key, not just because of slowing growth from pandemic days, but because they're facing up to $18 billion or more in a hit to their revenue over a period of years from competition in the generics market, as patent exclusivity expires on some of their longest and most well-known blockbuster drugs, and they have to contend, as all pharmaceutical companies do in the life cycle of their businesses, with generic competition. So these acquisitions are key to helping it not only combat that competition, but really, I think, enter into its new growth story post-pandemic. Management has been really, really intentional with the acquisitions that they've made. You're really just starting to see the very, very early fruits of that bear out in Pfizer's financials, especially because, some of these drugs are still to be launched that it acquired in its acquisitions. But something I mentioned was in 2023, Pfizer had more drug approvals than any other healthcare company by the FDA. So looking ahead over the next 5-10 years, these 8 or more acquisitions that they made during the pandemic, key there. A huge part of that is growing its footprint within the broader oncology disease area space, but also in these other disease areas that I mentioned, combating these revenue hit from the generics market. And I think that they're in a really good position to do that and to hit their goal of adding more than $20 billion to their revenue by the early 2030s. So that's really the company's growth plan moving forward. And you're in a transitional period now looking at this stock, anyone who follows or owns the business. But I think there's a really strong potential for the company over the next 5-10 years. So I'm excited to see what happens.
So I'm going to dig deep into the queue here. This is from Jimbo has a question from about 6 days ago, but I thought I could tie it nicely into our path to multi-baggers topic. And the question is, how much do you have in cash now? What are the determinants of your level of cash in your portfolio, more or less? So generally speaking, I don't keep a lot of cash in my portfolio. I generally add money to my portfolio on a monthly basis, and I add it directly into my investing account, and then I leave it there long enough for me to find something that I consider to be an intriguing opportunity, a compelling opportunity. So if I look right now, I have less than 3% of my total portfolio value in cash. Now, that is still enough for me to be able to tap into any intriguing opportunities that I see. You know, if I see a stock that I am interested in that drops precipitously, and I deem the reasons behind that drop to be nonsensical, and that happens fairly often, I don't have any qualms about, you know, buying another position in the stock. What determines my level of cash, though, is, you know, for me, I learned a long time ago that I want to stay more or less fully invested. I do want to have enough money that I can take advantage of an opportunity. If a stock that I think is on the path to being a multi-bagger or is already a multi-bagger, and it's not too much of my portfolio, then I'm certainly willing to add to it. So that's that's me personally. I don't know if you have an answer to this, Rachel, before I move on to my next question.
Yeah, I can add a couple thoughts there. I think I probably, I've talked about this a bit before, but I think I tend to probably keep a little bit more cash, you know, on the sidelines and in my portfolio, than perhaps some would do. And I think part of that just goes down to, you know, my own risk tolerance level. I always like having that there at the ready, you know, also for various investment opportunities. And of course, it's important to note that's separate, you know, from any cash I keep, you know, fully outside of my portfolio for life, my nest egg, you know, emergencies, having an emergency fund, all of these types of things. I think for me, it kind of depends on the, you know, the period of time in which I'm investing. As I've mentioned, the last several years is when I've really delved deeper into my investing journey. And so my approach so far has been to probably keep a little more cash than some might. But that might shift, I think, as I, you know, as my portfolio matures, as I mature as an investor, and as I build out my portfolio and am more comfortable with that shift in liquidity to my current investments.
Now, there's another question that I wanted to address, and it's a really good question because the answer is not as clear cut as you might think it is. This question came from Matt 19 minutes ago. If I have stocks that have gone up by at least 100% in less than 12 months and lists several, does that suggest valuations which have gotten ahead of the business? And the answer is it could, but not necessarily. And the reason that I say that is, and I want to use one of my favorite examples, which is NVIDIA. Now, if we go and look at NVIDIA stock, this is a stock that, and I think it still qualifies for how much it has gone up over the past. Let's see, it's a little bit less right now because the stock dipped a little bit. It's about 93% over the past year. But I think it still works for this illustration. And so if you look at NVIDIA's forward price to earnings ratio, and I talked about this earlier, it's got a multiple of 32. Now, generally speaking, if we look at stocks in, say, the S&P 500, I think the last number that I saw was around 29. So it's slightly higher than the broader market. But if you look at what NVIDIA is doing, in the most recent quarter, they grew revenue by 90% year over year. So this is a company that is performing at a high level. It's a company that has a very compelling opportunity ahead of it. But then if you go back and you look at what NVIDIA's forward price to earnings ratio has been, it's generally over 40 and 41, in fact. So you're looking at a stock that is historically cheaper than it has been. But because the market is a little concerned about the DeepSeek situation, you're able to get it at a discount right now. So for me, I would say you can't necessarily look at whether or not the stock has gained 100% over the past 12 months as a determinant of whether or not the valuation has gotten away from it. It's probably best to look at the valuation itself to decide that. And obviously, each stock is going to be a little different. I know Axon is one whose valuation is a little bit stretched. I don't follow Spotify that much, but I know a lot of fools who do. But I would say, I used NVIDIA as an example because it's stock that I follow closely. And it basically shows that you can't simply go by how much the stock has gone up as a determinant of whether or not its valuation is stretched.
There was a question that came in. Ed was asking, with the popularity of GLP-1 drugs, supposedly people using this drug get healthier. Does this drug involve help with diabetes, improve diabetes? Do diabetes drugs get hurt? It's an interesting question. I think it depends what kind of drugs you're talking about, right? So companies that make and produce insulin, these aren't patients that take GLP-1 drugs depending on what the use case is for. Let's say you have diabetes. It may or may not necessarily replace the need for insulin. I think one of the biggest areas where some people have been concerned about is these medical device businesses within the diabetes care space, like the ones like Dexcom I talk about that make CGMs, continuous glucose monitoring devices. And this has been interesting to evaluate from the perspective of someone who owns, I own a company like Eli Lilly, I own shares of, and they're, one of the leaders in this GLP-1 market. And then I also own shares of Dexcom, which is, making medical devices like continuous glucose monitoring devices that help individuals who have diabetes, pre-diabetes, to track and monitor their blood glucose levels. I think this is something that it's going to be a really time and truth and waiting to see what happens. I don't think you're going to replace the need, for example, for some of these medical devices that honestly could go hand in hand, right? So GLP-1 drugs help manage, as we know, blood sugar levels. They could reduce, in some of the studies we've seen, risk of heart disease and kidney disease. But essentially, they trigger proper insulin release from the pancreas. If you're using it for weight management concerns, it's designed to help increase feelings of fullness. But I think when you're looking, for example, at the use cases for this in the diabetes market, GLP-1 drugs are not a substitute for insulin, right? They can be used in combination with insulin. They can help with weight loss and blood sugar control. So you think of companies that operate in that space. They don't replace the need for continuous glucose monitoring devices, right? Even if a GLP-1 drug is effective and providing insulin management for a patient with diabetes, they are still going to need to wear these devices in many cases to track their blood glucose levels and monitor those and avoid adverse events. So something I've noticed is, stocks like Dexcom, for example, have, had these periods of time, especially in the last year or two, where they've really been beaten down by the broader market. And I think there is this kind of broader concern of, how are these drugs going to impact these flagship companies within the diabetes care space? And I think some of that goes back to kind of a misunderstanding of what GLP-1 drugs do and what they don't do. There is tremendous potential with these drugs, and there's a lot of companies that are working to get into the space, and that's something that is really exciting to watch as an investor and also as just an individual human tracking the expansion of this market. But it doesn't replace the need for a lot of the diabetes care products that these other businesses provide. If anything, it helps to complement them. And so that's something that I think is important to bear in mind when you're looking at this space. That's something that I've written about a lot. I think time will tell as to the potential use cases and applications of GLP-1 drugs across a host of disease areas, outside of, for example, diabetes populations, as well as for issues like weight loss. But it is important to understand the limitations of these drugs as we know them currently. And these companies that are making, the devices and other products needed in the broader diabetes care space, it's not replacing the need for those. So I think that's something to be aware of when you're looking at this space and the investability of it.
So there's a question that Vihan dropped in the queue about 15 minutes ago, and he said, Danny, as a Chipotle shareholder, ticker CMG, which stocks are you bullish on in the sector? Unit economics that potential to produce Chipotle-like returns, and he listed several potential stocks. And actually, there is one that I'm following pretty closely in the space, and that is Portillo's. Now, what I want to do is I want to share my screen here for just a moment, because there is a presentation from an industry publication called QSR. QSR is Quick Service Restaurant, and they share a list of their top restaurants and the unit average unit volume, AUV, which is a measure of how much business each location does. So I'm sharing that screen now. Now they break that up by companies that are above a certain size. Now, in this particular case, this is one that falls below that size, so they call it a contender. But if you look at this chart, what this shows is that Portillo's has delivered an average unit volume in 2023 of $9.1 million per. I'm not sure why that chart is not showing, but I'll just read from it here. $9.1 million in average unit volume per location. Now, among the top ranked companies in 2023, that is the highest average unit volume of any company in their top 50 of the contenders. And in fact, when you look at their top 50 companies, the larger companies, it's actually better than some of the big dogs in the space. And we're talking about the McDonald's and the Shake Shacks and some of the other, larger contenders in the space. So that's one that I'm really watching closely, is Portillo's. Their average unit volume aside, I'm really intrigued by management's focus on having happy employees, happy customers. They, for a while, refused to raise their prices during the inflationary period because they wanted to serve their customers. And so this is one that's really intriguing to me. The stock has not performed well over the past few years because its financials were suffering because of those strategic business decisions. But the stock has begun to turn over the past several months, and is doing remarkably well. Over the past 6 months, it's up about 22%. I think it has the potential to be the next Chipotle, or among that group of stocks that could be the next Chipotle. So I'm pretty intrigued by Portillo's, ticker PTLO. One other quick question that I'll hit while I'm in the queue. Ed asked this a little bit ago, in response to something we said earlier. He said, Danny, what do you think of the analyst from Bank of America that warned that the Mag 7 will have their day of reckoning this year? That's not exactly what he said, but just to share here. So the analyst in question is Michael Hartnett, who's an analyst with Bank of America. And he said that the U.S. big tech stocks that he originally referred to as the Magnificent Seven would be the Lagnificent Seven this year. And his concern is that these stocks have run up so much over the past few years that they're not going to keep pace with the market this year. I tend to disagree with him on that. We've talked about those stocks earlier in the show, and the Magnificent Seven stocks are all leaders in their industry. They're all set to benefit from AI. So I wouldn't discount them just yet.
You know, we had a question that came in a few hours ago. I know we have about a minute left, so I wanted to hit this. Thanks to the Motley Fool for the great learning experience. To health stock observers, what should we look for as the next milestone or event pertaining to Viking Therapeutics? And this was a comment that came in from Stock Around the Clock. The biggest thing to be watching right now is their GLP-1 drug that they're developing. I think this is what most investors are paying the closest attention to. They do have numerous other promising candidates in development, but the most far progressed candidate is VK2735. They are studying that again as a potential treatment for metabolic disorders, multiple, including obesity, as well as for patients with type 2 diabetes. It's worth noting that they are studying it both as a subcutaneous injection as well as an oral formulation. So there was considerable clinical benefit that was shown both in the phase 1 trial and phase 2 for the subcutaneous injection. In the phase 2 trials, VK2735 showed that up to 88% of patients experienced weight loss of 10% or more. In their fourth quarter earnings call, management said they are planning to initiate the phase 3 trial for this GLP-1 drug candidate. And this is specifically the phase 3 study for the injectable version of the drug. They are also working on the dosing phase of their phase 2 trial for the oral formulation, right? So the phase 3 trial for the injectable version starts in the second quarter of this year. They are already dosing participants in the phase 2 trial for the oral formulation. So watching these two trials, the one for the oral formulation is called the Venture trial. And then seeing any updates regarding the initiation of their phase 3 study, which again is planned for the second quarter of this year, will be the biggest needle movers for the stock moving forward. And with that, it looks like we're 1 minute over our time. I know we're waiting for Ron and Rich to come in. I think they're going to be talking about value stocks in the next hour.
Hey, Rachel, Danny, how are you? Good show.
Thanks.
We're doing well, and thanks very much, Rachel. And we will leave our viewers in the very capable hands of Ron Gross and Rich Greifner. Take it away, guys.
Thanks. Hello, fools. Welcome to the 3 o'clock Eastern Time episode of Fool24. I'm Ron Gross, coming to you from not so sunny Rockville, Maryland today. A little snow in the forecast here, but always happy to join you and to be joined by my buddy over there, Rich Greifner. Hey, Rich.
Hey, Ron. Hi, fools. My name is Rich Greifner. I'm joining you from the almost always sunny Santa Barbara, California. So, Ron, I'm not sorry to hear about your weather situation.
It was going to be a foot of snow. Now we're down to only about an inch. So I think we might be okay. Fools, we're going to talk value investing for the next hour or so. A reminder that we cannot provide any personalized advice, but we're happy to take as many questions that fall under the banner of value investing, which can mean a lot of different things to different folks. So keep the questions coming in Slido, and we'll get to as many as we can. Rich, I see in Slido from previous hours there are a few questions in the valuation section of Slido.
Oh, great!
So if it's okay with you, while we wait for more to come in, I'm gonna jump on some of the older questions.
Yeah, that sounds good. We can certainly do that. If you have some in mind, let's
Let me. The first one that comes to mind is from Ajit Jain, interestingly, who asks, "Do you think Buffett would be buying his own stock at the current valuation?" Very interesting question. Full disclosure: Berkshire is my largest position, has been for a very, very long time. Buffett usually says, Rich, correct me if I'm wrong, that he is a buyer at around 1.1 or 1.2 book value or lower or thereabouts. I I believe we're higher than that right now. We're probably 1.6, 1.7 times book. I think we're at over 2 times tangible book value. So I don't think you'll see any meaningful purchases from Berkshire at this price. But don't forget, Berkshire's looking for a bargain. He's a value investor. He has a very strict process that he sticks to, especially with his own company, of which he knows more about than anybody on the planet. So he knows what a good entry price is and perhaps when it isn't. So I would think you won't see any meaningful purchases here. Rich, what do you think?
Yeah, agree. I mean, if anyone should know, it should be Ajit Jain, who runs the insurance operations for Berkshire. You should know better than us if Buffett would be buying his own stock. No, Ron, I agree. I don't think Buffett would be buying Berkshire. In fact, he's not buying too many equities in general. It looks like he's kind of reducing some positions, most notably the banks. So he's building up. You know, they already have so much cash coming in day after day, quarter after quarter. But they're building up some cash, hopefully, for Buffett to be able to put to work at attractive prices.
Yeah, exactly. Maybe we should set the table a little bit while we wait for some questions to come in and just talk some generalities about value investing, because I do think it means different things to different people. So I'll put you on the spot and ask you, what does value investing mean to you, and then I'll take a shot at it as well.
Yeah, I actually have maybe an unconventional definition. I think the conventional definition of value investing is you're looking for a stock that is cheap based on some observable metric, right? So low price to earnings, price to book, cheap relative to what your estimate of replacement cost. I think most people would say ballpark, that's the definition of value investing. I've never really liked that definition. I find it limiting, because if you find a stock that is obviously cheap, it's usually, almost always, it's obviously cheap for a good reason, right? The stock stinks. People don't want to own it for a good reason. So I've always preferred Joel Greenblatt's definition of value investing, a value stock, which is really, I want to estimate what a stock is worth and then buy it for much less than that amount. So under that definition, anything can be a value estimate. Just figure out what it's worth and then buy it for much less than that.
Not always an easy thing to do, but
easier said than done.
But it's beautiful when you can find it. For me, it's very similar. Obviously, it's also using various valuation tools, and there are many: relative, absolute, discounted cash flows, multiples, ratios, to get a sense of what you think a company is worth, sometimes called the intrinsic value, and then deciding at what price I need to purchase it at to get the rate of return that I'm looking for the risk associated with that investment. Is it 10%? Is it 12%? Is it 15%? Whatever the number is that I'm looking for out of an investment, and that number might go up the more risky a stock is perceived to be. That's what I think of when I think of a value investing, using valuation tools to help me make, buy, and then eventually sell decisions as well.
And so that gap between the intrinsic value and the price that you pay, we call that the margin of safety. So the wider, the better.
Because we're all going to make mistakes. And if you think a stock is worth 20 and you buy it for 10 and you were wrong and it's only worth 15, you're still pretty good because you've got that safety.
Yeah, pretty good problem to have.
Yeah, for sure. Let's take a look, see questions. Like Buffett, Jimbo.
I like that one from Jimbo, if you want to do it.
Sure, I'll just read it and you can take it. Like Buffett, the tendency is not to buy now. The market is expensive. What do you do in this situation? More specifically, would you buy anything now? And if so, what?
Yeah. You're not wrong. The market is expensive relative to historical figures. Having said that, the market is pretty bonkers right now, where if you define the market as, say, the S&P 500, you've got the top 7 or so companies that are soaring, and the bottom 493, not so much. So there's big bifurcations and dislocations in the market, where you've got certain classes of companies that, they appear very expensive. But I'm not having a particularly difficult time finding attractive opportunities. And that's true in just about any market. There's always going to be something that's overlooked, something that's out of favor. It doesn't matter whether the market is at, near a 52-week low or a 52-week high. I'm not really looking at the market for cues on whether I should be buying or selling. I just look at, am I able to find an attractive opportunity? And frankly, I don't really care what the market is doing. Ron, I suspect you'll give a similar answer. Are you in the same camp there?
I'm in the same camp, but I do do some index investing as well. I'm not just an individual stock investor. So when I think of the 7 stocks that you mentioned in the S&P 500, I also then think about the S&P 500 equal weight index, ticker symbol RSP, as a way to play the broader market and take emphasis away from the Mag 7 that are such a big part of that. Last time I was on, Tom Gardner and I were talking about sometimes having a little bit more cash than other times, and we don't like the word market timing because we don't really believe that market timing is the way to go. But on the margins, there are some times where you can't find as many opportunities as you can in a different environment, and maybe then you actually do have a little bit more cash than you would otherwise. The numbers, the stats say you probably would be fine being fully invested all the time, because the market does obviously go up on average 9-ish% a year over long periods of time. So you're fine, I think, doing that as well. But I think the mistake would be to say the S&P 500 is at 28 times earnings right now. I don't like it. I'm going to move to cash. Because if you miss the top 5 days a year, your rates of return are going to be very different than what the historical rates of return have been, and you don't want to do that. That's why we don't recommend timing the market. Staying in the market through the bumps, the ups and downs, the 25 times earnings, the 30 times earnings, the 20 times earnings. It's going to even out over time. Stick with great companies when you can. Hold them for long periods of time. Companies that can compound rates of return and continue to grow for years and years and years would be the ideal. Shop in fish in the waters that Rich and I fish in sometimes, where it's the unloved company or the unknown company, even something that isn't as obvious or isn't in the news every day. And we can talk about some of those as well, Rich.
Yeah, it's interesting that you specifically mentioned the PE ratio there, where, 20, 25, 30, and, as it gets higher, the stock is looking expensive optically, like I was saying. But just because a stock carries a high PE does not mean that it's expensive. In fact, a stock with a PE of 5 could be overpriced, and a stock with a PE of 50 could be cheap. It depends to what extent does that the current period earnings, represent the true, like, normalized earnings power of the business. If you've got something that's got a lot of growth ahead of it, or a lot of margin improvement ahead of it, that deserves a high PE. It could be cheap.
Totally agree. And I would actually just a little caution about what we call relative valuation metrics, which are multiples like PE. As Rich said, in a vacuum, a PE of 20 doesn't tell you that much. You need to compare it to something. Perhaps it would be the PE ratio historically of the company, or the PE ratio of the competition, or even the PE ratio of the S&P 500. But in and of itself, it doesn't tell you that much. If you want a standalone metric to help you understand something like a discounted cash flow, where you're actually using the cash flows of the company to decide what it might be worth under a set of assumptions, that would be an absolute valuation metric that doesn't need as much comparison as something like a PE ratio. I see, Rich, a question from Vihan about turnarounds, specifically mentioning several different companies: Intel, Boston Omaha, AMD, Appian. I don't necessarily have opinions on those specific companies, but we could spend a little time tossing around the concept of turnaround investing.
Yeah, happy to. I mean, to quote Buffett, as we always, the obligatory Buffett quote, he says, turnarounds seldom turn around. And that's true. But what's interesting about this question is a lot of these aren't what I would describe as turnarounds. They're companies whose share price has fallen, but the underlying business is fine. It's just, this people got too excited about this stock in, 2021, and the stock price subsequently fell 80, 90%, which is, that's brutal. But the underlying business, that hasn't, declined by 80%. The underlying business is fine. So could these be value investments? Absolutely. But I wouldn't characterize a lot of these as turnaround situations. As far as an actual turnaround, oftentimes you will find value there, but that is, to my way of thinking, that's when you're turning around a business's operations, right? Like the company has been struggling, they implement a new strategy, they change up management, something like that. That is what I would consider a turnaround. It's not just a company whose stock is in the dumps.
Totally agree. And that's kind of where you can get into the concept of value traps, because as you said at the top, Rich, turnarounds don't always turn around. So you have to be careful. At this point, I can almost feel it when you're getting yourself into a trap situation, because you're hoping upon hope, which is not an investment strategy, by the way. Hope is great, but it doesn't really pay the bills. But when you're hoping upon hope that something is going to happen because it's not going well, it's not going well, it's not going well, those often end up being what we call permanent loss of capital investments, which is the scourge of the value investor. So you have to be careful. There are stumbles that companies take that if you don't think the company is as impaired as maybe the market thinks it is, you can have a contrarian view, which is often associated with value investing, and maybe buy a stock at a relative cheap valuation because you see some steps the company is taking that will right size the business. I like Target as an example. Target has stumbled really since the pandemic, being wrongly merchandised, and some other stumbles as well. They've got a plan. They're executing. It's not necessarily going great yet, but I do believe in the long-term business model of Target, especially as they've moved to same-day delivery and their Shipped program, and their curbside program. So that would be one where you say, okay, this stock has stumbled. The market is not a fan of it. The stock's like at 14 times earnings. There you go, the P ratio again. But relative to like Costco at 57 or 52 times earnings or something like that. So it's relatively cheap. It's relatively cheap for a reason. They're stumbling. They pay you a 3.4% dividend. And if you don't think Target is going anywhere permanently, that's like an interesting kind of turnaround concept for me. Nothing that's too impaired that's getting, there's plenty of people who are doing restructuring investing and bankruptcy investing, and that's a way to go too. That's difficult for me.
Yeah, I personally try to avoid situations like that. Having said that, nothing's truly off limits. I mean, even the hairiest situation, if you can buy it at a cheap enough price, that gives you that margin of safety that, Ron, that you were mentioning earlier. So I'm not opposed to a really hairy situation, but I typically try to avoid, anything looming on the cusp of bankruptcy. You could make a lot of money there, but you've also got a potential zero.
Yeah, for sure. So that's a little hit on turnarounds. I see a question that we can talk about GARP investing, growth at a reasonable price, and I see in need input. Hey, Rich and Ron, what are some GARP businesses you can think of at this time? Rich, why don't you explain what GARP investing is all about?
So GARP stands for growth at a reasonable price. So you've got a company that's growing at a decent rate. The price is not, what we might consider cheap, but good business. Pay a fair price for it, hold it for a long time, you'll do just fine. I think actually growth at a reasonable price, GARP, describes probably the majority of our Foolish offerings, I would say. I mean, most of the Motley Fool recommendations tend to have good growth characteristics, good quality businesses, large addressable markets, good management, sound financials, all the qualities that you would want. Businesses like that, typically carry a reasonable, fair price tag because people want to own those businesses. It makes sense. So if you can find, Ron was saying, a high quality business like a Costco, I wouldn't. We might disagree on this one. I wouldn't say that their price right now is reasonable. I think Costco is pretty overvalued, but that's the kind of business you get. You can be pretty confident in their future growth. Not a lot of surprises I can think of that's going to disrupt that. If you have the opportunity to pay a reasonable price for such a business and you intend to hold it for a long time, you'll do quite well.
Back to Buffett, I feel like over the years, he's really turned more to buying quality businesses at a reasonable price than he was focused in his earlier days on cigar butt investing or really deep value investing. I think that was a lot of Munger's influence on him, actually, telling him to look for quality at a reasonable price or growth at a reasonable price. And he's done pretty well.
All right, but I need input. People want tickers, people want ideas. So I blathered on about what GARP is. One example I was thinking of, Pinterest. Pinterest is a company I followed for years. I just like what they're doing. They've been the platform has a lot of value, both for the pinners, the users, and the advertisers. And something I like about Pinterest is they've been very deliberate in monetizing that platform. They're very careful to build value for all the users on both sides of the platform, and only then are they slowly increasing the monetization. And maybe that hasn't happened at the pace that Wall Street might like, but there is a lot of untapped monetization potential in this platform. This is a company I think you can pretty confidently say will grow at attractive rates for the foreseeable future. The price right now, it's not overly cheap, but nor is it expensive. So Pinterest, I think, is kind of that nice middle ground, GARPy style company.
Agreed. You mentioned Costco and how you don't think it's cheap. Another stock that's a large position of mine, and I would tend to agree it's not cheap. I have not sold it because I think it's a very high quality business, but one would have to question what the rate of return is going forward at this valuation. But that does get us into the latest question by Sadaf. Excuse me if I'm pronouncing that wrong. What is your stock sell criteria as a value investor? It's much the same as my buy criteria, unless, well, there's two few different things. One is if my original investment thesis is busted or no longer applies, and whatever it's been replaced with isn't as exciting to me as the original thesis. And then if there's any moral or ethical issue as well, of course, that's just a personal decision whether to hold on to a stock or not. But when it comes to valuation, it's, will this stock, like I just mentioned with Costco, at the current price, remember, it's only the current price is the only thing that matters. What you bought it at doesn't matter. It's what the price is now and where it's going in the future. So where it is right now, can that provide me with the rate of return I'm looking for out of my investments, commensurate with the risk I'm taking for putting capital into that investment? If the answer is no, then you can sell or at least lower your allocation, lighten your load, reallocate some or all of that capital to something that will give you the rate of return you're looking for. Is that how you think about it, Rich, or additional things?
No, that is how I think about it. I will say selling is the hardest part of this game. I don't think it's that difficult to identify a great company, and it's slightly more difficult, but not so difficult to figure out what you estimate it might be worth. But figuring out when to sell it is really tough. And I would just say I've been working at the Fool for 18 years, and it's a lesson that's just been drilled into me time and time and time again, is if you find an exceptional company that has great management, strong competitive advantages, great growth prospects, great financials, intelligent capital allocation, all those things, you want to be really careful about selling that. Even if you run your DCF valuation, you say, "Oof, this thing's getting pretty pricey." I mean, I cannot tell you how much money I have cost myself by adhering too much to what my spreadsheet says and not just making the simple decision: is this a great business? Yes. Buy it, sit on your hands, go to the beach. My returns would be so much better if I just bought some of these.
Chipotle back in the day comes to mind, right?
For sure. I own Chipotle. I bought it. I mean, the market cap at which I purchased it is ludicrous. I knew that business really well. I believed in its long-term growth prospects, but the price got just too high relative to my estimate for its future earnings power. And the thing that I didn't count on, so I had a pretty detailed model, and I really knew the business well. Not to toot my own horn, but like I feel like I really understood the business. And the thing that I just didn't see coming was the digital ordering. So I figured you could only, the problem with Chipotle was throughput. It was always, you could only fit so many people through the line at one time. And so you figure a lunch hour, people eat there, maybe, the peak period is say 12 to 2. There's only so many people you could physically fit through the line from 12 to 2. Okay, fine. They came up with digital ordering and a second make line. They significantly increased the throughput while their expenses remained relatively fixed, totally transformed the model. I mean, I did not see that coming. And that's a great example of these wonderful businesses. They have optionality where they can provide you with positive surprises and just exceed even your highest expectations. So again, you want to be really careful about selling one of those. Just, you can take it from me. You could really cost yourself by selling too soon.
I will echo what Rich said. As a value investor, I have sold stocks too soon my whole life. I've tried to stop doing it. Still owning Costco might be a good example.
Yeah.
But I have left lots and lots of money on the table. Now, thankfully, don't worry about me. I'm fine. But we have both left lots of money on the table by selling too quickly, adhering too much to a spreadsheet, which is filled with assumptions that you may or not have gotten correct. And the optionality, our friends over at Rule Breakers, and really originally from David Gardner, can see those options and the future so nicely. I'm not that good at it, quite frankly. I'm a more here and now, and I struggle with optionality. But it's such an important part of investing where you can eke out years worth of returns in addition to what you think your spreadsheet says. So if you're going to adhere to valuation investing, valuation based investing, just keep an eye on I think it's a common refrain from value investors that they sell too soon.
Oh, for sure, and buy too early. But
Yes.
So we've addressed selling from a quantitative standpoint, but there's also the qualitative life quality standpoint, where if you are lucky enough to own one of these big winners, you can find yourself in a good problem to have, where the stock just grows into an outsized percentage of your personal portfolio, and you might feel uncomfortable with that. So the advice that we tend to give is, every investor has to make their own sell decisions, but you should have no single position should be causing you stress and adversely impacting your ability to sleep at night.
Totally agree. And just building on the sell conversation, Sadaf asks, do value investors sell stock immediately when the stock exceeds the fair value range? I think some may. I think that is a mistake I have made. Without getting too much in the weeds, I will just say that when a stock becomes fair valued, depending on your model, it still can theoretically grow probably 10% a year, even after that. That's just the way models work. So you would be leaving that 10% on the table. That's about a market rate of return. So you're not going to be knocking the cover off the ball at 10%, but it's still a healthy rate of return. And if all your investments did that, you'd probably be fine over long periods of time. So I wait until valuations nicely exceed my fair value estimate, because then I'm only maybe earning 5 or 6% going forward. And that's not a market beating rate of return. And I could probably do better elsewhere.
Yeah.
Your thoughts similar?
Yeah, no, totally agree. Nothing to add here.
Okay. Sounds great. Oh, Jimbo wants to know what service you've been working on, Rich.
Yeah, I work on a service called Value Hunters. I've been on that for the past 2 years or so. So come by, check us out. We're putting these value investing principles in practice.
And doing quite well. I will toot your own horn for you. Well, let's spend a minute on that, because some of the stocks you found, I bet most people have not heard of. Take us through maybe the process of how you uncover a company that isn't in the news every day, and it isn't kind of something that's on the tip of our tongues.
Yeah, I wish I had a process. The ideas just come to you. You know, if you're to be successful at investing, I think you just have to be curious and just pull on threads, and one thread leads to another. And you research, you know, if you research 10 companies, maybe you'll find something interesting. If you research 100 companies, you're for sure going to find something interesting. And then you just follow the thread. You find an interesting company. You know, we've talked about Costco a bunch. You know, you study Costco, you learn about the business, you run evaluation, say, I can't get comfortable at this price. No offense, Ron, but you know, I don't like the prospects of earning a, you know, super normal return from here. But in the process of researching Costco, you find something else. There's a competitor, there's a supplier. There, you know, one member of their board of directors also serves on another company's board. Oh, that's interesting. Let me learn about this company. And you eventually, if you just keep working, you will just stumble your way into something interesting that not a lot of people are clued into. I wish I had a better way to explain my process is ABC. It isn't. I fall onto ideas and I'm naturally curious, and that leads me to attractive situations.
That's interesting. The traditional screening won't always find you the companies that you're finding over at Value Hunters.
Well, I'll tell you, Ron and I used to work eons ago on a service called Deep Value. This is probably the 2010 timeframe, Ron. And back then, you could run a screen, and it was effective. You could just run a screen for statistically cheap companies, and it would spit out 10, 20, 50 opportunities. And you could go through, and in that list of companies, you could find something really compelling. And I don't know what it is, if it's just more and more savvy investor, it's probably, you know, algorithms just scanning everything. But the screens have dried up for me, at least, where now if you run a screen, you find something that is statistically cheap. I just find it is almost always overwhelmingly, there's a reason why it's cheap. This list has already been combed over. The good stuff has been plucked out, and you are left with the husks.
You know what? I'm starting to use AI prompting in place of screening, traditional screening, because you can get a little. It's different than just looking at quantitative metrics.
Yes.
Is it EBITDA under 8 or not, or whatever it is. You can search through qualitative and quantitative data, and it may not be a winner every time, but it can give you places to look, ideas that you can then go ahead and research, and until you find that diamond in the rough. So it's in its relative infancy, the prompting replacing screening, but I think it's exciting.
Yeah, for sure. So Ron, can you give an example of like a qualitative variable that you might layer on top of a quantitative screen?
It could be something, management change. What companies have recently undergone a management shift, but still having a return on invested capital of 15% or higher, but margins have recently dipped. I mean, you could make up literally anything. What industries have had a new competitor recently come in to steal market share? What companies have been in trouble from a market share perspective recently? I guess that would be considered quantitative, but sometimes that data is not necessarily readily available from an SEC document. You have to pour through lots of other type of news items to kind of uncover that. AI tooling can help you get there.
I like that. You want to give the people some stock ideas? Anything compelling? I see a question from Vihan. Any value investing ideas in small caps, mid caps, and large caps? What are you looking at if in event of pullback? Ron, do you have anything?
You do it. You're more in the day-to-day,
Sure.
week-to-week stock picking game.
Happy to. Yeah, and again, you know, my service Value Hunters, we've got a bunch of recommendations that you know, we think are very attractive buys right now. One idea I'm particularly enamored of that I will share and no one will buy And that's the thing with value investing is, for whatever reason, people are just not interested in these opportunities. So even though I think they're great, I have no reservations about sharing because no, people very rarely take action on it. The company is Marlowe, ticker MRL. It's traded on the London Stock Exchange. And Marlowe is a company that provides fire and safety services. So testing, inspection, and certification for a building's fire systems, its safety systems, its water systems, things like that. The beauty of this business is it's required by regulation. This is a non-discretionary expense. So even in tough economic times, if you want to continue operating your business, you need to have someone come out and physically inspect your property. Make sure, okay, the sprinkler systems are working. You have the fire exits clearly marked. The extinguishers are refilled. So it's predictable, recurring revenue that is regulatorily required. A business like that should trade at a high multiple because it's predictable and it's recurring. They generate lots of cash flow. It's every characteristic you would want. This business does not trade at a high multiple. The company tried to sell itself last year. They didn't get the price that they were looking for. So they spun off one chunk of the business, sold another chunk of the business to private equity. They're just streamlining operations. They are basically just printing cash, and the management team is using that cash to repurchase shares at what I consider to be very attractive prices. So again, the ticker is Marlowe, or the company is Marlowe, ticker MRL on the London Stock Exchange.
Love it. Another ticker related question just came in from Matt. Ron, isn't Garmin a stock you like? Thank you for remembering, Matt. Up 11% today after reporting earnings this morning. That is true. I haven't had even a chance to look at it. I saw it up 14% earlier today. Reported earnings, I think revenues were up 25%, operating income up more than 50%. I'm sure there's some things you got to back out there to do apples to apples, but I haven't had a chance yet. But it is a company I've owned not forever, but certainly several years. Probably during COVID is if I'm guessing right, is when I bought it. Again, using just relative metrics, just to briefly chat about it. 27 times for Garmin. It's not terrible. It's not dirt cheap, especially after today's run up. I'll have to digest what this growth is all about, what management is saying about future growth. Is there any kind of new lines of business or something that is causing them to have earnings that were significantly better than the consensus estimates? So I need to do a little bit digging, but on a day where a stock is up 12 to 14%, it's all good with me.
Garmin's a great example of a company that would have been a good pick for a value investor. Because I mean, the popular narrative, and one that I fell prey to, is this company's going to be a dinosaur. This business is doomed, right? You've got smartphones coming up. Why would I ever need a Garmin? But I guess they have a differentiated use case that's proven sustainable. So anyone who is willing to do the work and hold a contrarian opinion has been nicely rewarded.
Agree. I saw a question. It seems to have disappeared, but it was along the lines of why is EDIT up today? EDIT is Editas Medicine. It's a gene therapy stock that I happen to own as part of a basket of gene therapy stocks that I've owned for years and years and years. Gene therapy stocks in general have been really strong lately. Partly because of some good clinical data that has come out, but also because they have been absolutely decimated. So it's a bit of a dead cat bounce there. Funny industry for a value investor to be talking about during a value investing segment. I guess my lesson, just if we're talking lessons there, is if you're going to invest in something that you don't fully understand and that you can't really value, be careful and do it as I've done it in a basket form where you spread your risk out across. I think I maybe at one point owned 11 gene therapy stocks. 4 of them, 2 of them were acquired, 2 of them I sold. So maybe I'm left with 7 or 8 right now. I will have you know that one of them is up significantly and every other one is down. So you almost need that basket to even out your risk. And biotech, as our friend Carl Teal would tell you, has had a rough go of late. Gene therapy stocks were hotter than hot. Gosh, how many years ago? 7 years ago. But really has cooled off. But the technology, the gene editing technology, is really, really interesting. So they're having a good week, and Editas is more of a penny stock at this point, so it doesn't take much to get that stock to jump. But you have CRISPR, Intellia Therapeutics, Beam, or some other ones as well that appear to be on better footing and more established.
Got another one here from Vihan. Ron, if you want to brag a little bit, he says, "Gentlemen, would be nice to hear from your portfolio a value investment idea that produced outsized returns."
Outsized returns.
Thankfully,
yeah, you go ahead. Yeah,
I can start if you want time to think of one.
Yeah, sure.
We just tell a story of how this works out in practice. This is a pick that I made when we worked on Deep Value. It's probably 2010 timeframe. It's Crocs. And This was a turnaround. This one had every hallmark of a value investment. It was just a company no one wanted to touch. So Crocs came out probably 2004, 2005 timeframe. It was the hottest thing, and it was plastic shoes with holes in it, and it was just kind of like a novelty. It wasn't really a sophisticated management team. It was basically 3 fishing buddies who came up with the idea. They just wanted a shoe they could wear when they went fishing, and that could, hold up to the water. And so, 3 relatively unsophisticated operators stumbled upon a firecracker, an idea that caught on, and they did what you might expect. They just tried to expand as quickly as possible. It wasn't very strategic. If you remember, they were just selling Crocs in these kiosks at the mall. That was like the primary distribution mechanism. So their inventory was out of control. The channels were terrible. They didn't run the company well, and the stock went up the escalator and then got beaten down. And for years, no one wanted to touch it. Everyone dismissed it as a fad. But they brought in professional management, and I really liked the new guys that came in. They recognized this is going to take a lot of pain. We are going to have to clean up and fix these operations. It's going to take years, and it's going to be uncomfortable, and nobody wanted to endure that. But the price just got so absurdly cheap. And this was a situation, something that I really like is when you see something working, and it's obviously working, and quarter after quarter, management is doing exactly what they told you they were going to do. And you can just see it in the numbers. They are improving and improving and improving. And you can just see a path to significantly higher earnings power in the future. But everyone's clinging to the old perception of the company, and they haven't adjusted to the new perception. And that's what happened with Crocs. This thing was dead money for the longest time, but you could just see underlying the business was getting better and better every single day. And these guys were making the right strategic decisions. And this is another one I sold way too soon. I did okay in Crocs, but I should have done great. I sold it way too soon. But investors who bought near the lows and held on, it's probably at least a 10 bagger, maybe 15 or 20 bagger from the bottom.
Yeah, for sure. Skechers was another one that we did a nice job on back in the day. One that comes to mind for me, which is both exciting, but also there's a bit of a cautionary tale, was Domino's, DPZ. And I want to say about 14 or 15 years ago, I recommended the stock at $4 a share, and it's now at 400. Now, I wish I could say I still own it and have made 100 times my money, but the value investor in me, I probably sold when I made 3 or 4 times my money, maybe like in the teens. It makes me sad just thinking about it. That's life-changing kind of returns, which I did not partake in. Hopefully some of our fools continued to hold it for many years after I did. But it was a great kind of, it was by no means a give me, but they were changing their menu. They admitted their pizza was mediocre at best. It was back in those days. They've done a great job, obviously, with delivery, with digital, and they stumbled a little bit. COVID was good, then post-COVID was not good. Stocks fine lately. I think it's probably around 27 or 28 times earnings at this at this level here. The growth numbers look pretty good again. So I've actually repurchased it maybe a couple years ago, I want to say. I don't recall exactly when. So I am an owner of Domino's, but from 4 to 400 would have been really pretty sweet.
Yeah, hey, but like without sounding patronizing, I'm really proud of you. Like it's so difficult to go through that experience and then buy back in at a higher price and not just kick yourself, say, well, I missed it. There's nothing I can do about it. Wow, that is very impressive to me that you were able to do that. It's something I struggle with.
Yeah, I appreciate that. I do think a lot of behavioral finance and value investing go hand in hand from time to time. A lot of the lessons that I said, what you own a stock at is irrelevant, whether you're up or down on a stock is irrelevant. Obviously, letting your emotions not allow you to get either in a stock or out of a stock can wreak havoc on one's portfolio over time. So definitely for those looking to kind of up their game and be even a little more sophisticated, learning when your mind can play tricks on you and stop you from making good decisions is a really important part of investing.
Something that's interesting about value investors is I think we tend to be a lot more comfortable buying a stock as it drops. You say, oh, I'm getting a better bargain. It feels psychologically, it feels good. Like I'm averaging down, right? I'm taking advantage of this bargain price. And we're not as good as averaging up. And that's something, Ron, I know we've seen just watching David Gardner over the years. If a company is executing and the stock price is higher, it could actually be a better investment at that higher price. I know that's something it's really difficult for me to get comfortable with. I'm much more likely to buy on the way down than I am on the way up. But David has shown time and time again, if you've got a company that's you think is going to be a winner and they're executing, you can average up and that's where you can really crush it.
Couldn't agree more. And I also would agree that it's been something that I have not benefited from. I'm not good at it. Our folks over at Rule Breakers and David Gardner in particular, as you said, just wonderful at doing that. And sometimes it makes perfect sense when a company is executing and has years and years and years of outsized growth ahead of it. You can pay a little bit more because, as I said, your original cost basis is kind of irrelevant. It's what's the opportunity right now.
Yeah, the longer you hold the company, the more the performance of your investment will reflect the performance of the underlying business. Whereas the shorter you hold the company, the more dependent you are on getting that attractive initial purchase price.
Agreed. Any of these tickers you follow, Rich? Unity, anything there? Any of the oil and gas?
Chevron? No, I wish. I'm pretty worthless on any company that you might consider popular. My opinion is going to be pretty worthless.
You know what I do? Sometimes if I want to play a theme, like what would be a good example? Infrastructure stocks. When Biden put the CHIPS Act into place and their government was going to be putting billions of dollars into infrastructure. But I didn't necessarily have any expertise in any one particular company. I will use ETFs to play a theme there, which I think is a really great way to buy a basket of stocks. You can do it individually, but if you just want someone to do it for you, buy a basket of stocks that addresses a specific theme. I think is a perfectly good way to go.
And so that's something you did specifically for infrastructure?
Yeah, I've done it before too. I don't know much about banks.
Yeah.
But when I have wanted to participate in financial stocks, I've done it through ETFs. I'm sure there's other examples that are just not coming to me right now. Let's see.
Yeah, keep the questions coming, fools, because Ron and I are running out of steam. We're happy to answer whatever you got.
I'm trying to, there's a question about one of the gene therapies companies, Intellia Therapeutics. It's Intellia, NTLA is the ticker symbol, Vihan. Hopefully that'll help you find it.
Hey, Ron, while we wait for member questions to come in, I'll give you some of my own. What do you think are some of the biggest mistakes that new value investors tend to make?
There's so many, Rich. I would think being too reliant on a spreadsheet, on numbers on a page. As we said, selling too soon, being too conservative at times. Now, it depends. If being too conservative helps you sleep at night, by all means, be too conservative. There's nothing better than sleeping well at night. But I do think you can leave money on the table by being too conservative. Open your mind to potential growth areas. You called it optionality earlier. Build models that have optionality built into them, so you could see what would a stock be worth if Chipotle introduced digital, or whatever. And if you don't even have a vision, just introduce additional growth into your model for whatever. You don't even know for what, but you want a sense of, if this company grows more than I think it will, what could it potentially be worth? It's just a good idea to have that. I don't think you need a multi-page Excel spreadsheets, discounted cash flows. I think just like Mr. Buffett can do it on the back of an envelope, I think many of us can run the same kind of analysis pretty simply. Nowadays, there's so many ways. Discounted cash flow calculators, even all the AI tooling can help us come up with models. You and I used to do something called earnings power value back in the day, which is a very simplified kind of discounted cash flow that assumes no growth going forward. So you could see what a company would be worth in a no growth environment. I think I would don't be too anchored to the spreadsheet. How about you?
Yeah, you brought up a good point I'd like to kind of segue into too, is when I model, it's not just like one precise value point that I'm forecasting. I tend to forecast 3 different scenarios where one, what do I think is most likely to happen? What if things go much better than I think might happen? And what if things just go south? What's a bear case scenario? And so I've got 3 different possible growth scenarios in the future with 3 different intrinsic value estimates associated with them. And then over time, you can track how is the company doing relative to those forecasts. And if it's following, the optimistic path, maybe you could assign a greater probability to that outcome in a blended type of valuation.
Nice. Yep. Totally agree. Ron, are you in a position to share ETFs you are invested into if they're in a taxable or retirement account? Thanks for the question, Behind. I can discuss some that I own. I do have sizable positions in ETFs. I'm probably 50% individual stocks and 50% ETFs. Some of those are broad indexed ETFs, such as the S&P 500, the SPY, the Russell 2000, IWM, the Russell 2000 Value, IWN, RSP, the S&P 500 Equal Weight. So lots of stocks like that. If we're going to look at kind of, and I'm flipping through a spreadsheet here, some sector-based ETFs, I do own, as I mentioned, some infrastructure. An example of that would be the GII, which is the S&P Global Infrastructure ETF. I do own the Fidelity MSCI Financial ETF. I own the SOX, which is the iShares Semiconductor, because I did want to participate in the semiconductor boom that we've been experiencing, but I am by no means a technology analyst, and so I would have found it difficult to make the right call there. So that's the kind of thing I like to do through an ETF. Any ETFs in your portfolio, Rich, or you're purely stock?
No, all stocks all the time.
Nice.
But speaking of stocks in my portfolio, so Therapist Fool asked a question that has 19 upvotes. So this is very clearly what the people want. Ron and Rich, what stocks have you added to recently that you were allowed to talk about that you saw as good value? So I don't buy too often. I buy pretty infrequently. but I believe the stock I purchased most recently was Marlowe. That's the company I referenced earlier, the UK fire safety and security company. But I'll give you another name. I own a company that is in the process of being acquired, and if it is acquired, that position will turn into cash, and so I will then have cash to redeploy into a new investment. And a company that I would happily buy at current prices that I talk about at every opportunity is Burford Capital, ticker BUR. And Burford is the leading provider of finance to the legal industry, which it's not exactly a common concept, but basically what that means is they will fund a lawsuit that they believe is meritorious. So Ron, if you owned a company and say hypothetically you felt Oracle infringed one of your patents, and you consider suing them, and Oracle says, well, we'll countersue you and we'll take you to court. It's going to cost you millions, tens of millions of dollars, years. It's going to be a huge distraction for you. Even if you thought you had a good case, you might choose not to sue that company just because it's going to be such a hassle. It's a legal process. Even if your case is meritorious, you might lose. And if you do, you as CEO, you're going to be in trouble. So you might say, I'm not going to pursue that case. But here's where Burford comes in. Burford says, hey, Ron, I will fund your lawsuit. I will give you the capital to pursue it in court. And if you lose, no problem. You don't owe us anything. But if you win, we're going to get a very attractive return for the capital that we use to finance your lawsuit. These guys are the biggest and the best. They have unbelievable competitive advantages in terms of expertise, data, relationships, brand. And these advantages are self-reinforcing. It's just this very powerful flywheel. They earn phenomenal returns. They've achieved a successful outcome in something like 90% of the completed cases that they've financed so far. And there's a potentially enormous catalyst coming where they finance the case against the Republic of Argentina that's been about 10 years in the making. Argentina has been defeated at every single step of the process, and they keep appealing, extending, delaying, denying. At some point, that bill is coming due. And if and when Argentina pays, they owe Burford an amount that is equivalent to about double its market cap. So Burford Capital, BUR.
I'm a shareholder and my fingers are crossed. For me, what have I purchased recently? Believe it or not, NVIDIA, because I had FOMO, which is not a value investing strategy, but I wanted to participate because I find it incredibly fascinating what's going on. So it wasn't really about making money there. It was about participating in what's going to be an amazing future and technology. Target is I purchased some more Target recently. I mentioned that earlier as somewhat of a turnaround play, or buying a stock when things are not necessarily going perfectly, and as a result, hopefully getting it cheap and not as a value trap. Those are the Burford as well. Thanks to Rich. Those are some names that come to mind.
Very good. Hey, Ron, do you add money regularly, or do you wait and invest in more of a lump sum fashion?
Well, always through 401k. I'm constantly so putting money into the market there. I consider that to be just as good as adding money to my non-retirement accounts as well. When I do add money to my retirement accounts, to my non-retirement accounts, it doesn't necessarily get invested immediately. It depends on the time I have. Sometimes if I don't have time, that's where I will buy ETFs if I just want exposure, if I want to get capital invested. Otherwise, I'm just patient. Sometimes the cash will add up for a bit. Then, once it gets to be, a few percent, 5%, that gets me a little itchy, and I'll start to put that to work. How about you?
I try to be fully invested at all times, which is why like I was saying before, I haven't really made a big purchase recently, but then when you have a liquidation event, a monetization event, all of a sudden it's, like, I'm a kid in the candy store. I have a large amount of capital coming in, and I'm excited to deploy.
Yeah, that's always fun. It's funny how sometimes value investors get disappointed when a liquidity event like an acquisition can occur, because you feel the acquiring company got a good deal, and otherwise they probably wouldn't be doing the acquisition if they weren't getting a good deal. And we feel the stock still has upside, maybe for years to come, that's being taken away from us. I don't get that bent out of shape, because I can just reallocate that capital to something that I like as well. But I see all the time people saying, shoot, I'm going to make a quick 30-40%, but I thought I would be in this for years and have a multi-bagger.
That's precisely how I feel about the company that I own that is being acquired. However, I will say, I'm not an insider. I don't know what's happening. You never know what's going on inside a business. Even if you work at the company, you don't always have a complete perspective on, competitive dynamics, what the future may hold. So if the management team feels that this was an appropriate price, as an outsider, I disagree. I think they're selling a little cheap, but they have access to much better information than I do. So I should probably be deferential.
That's fair. Yeah, that's fair. Sounds good. So it's 4:00. That went quick. A lot of fun, Rich. Thank you, fools, for joining us. I hope you had fun chatting about value investing for an hour. Really appreciate the questions. Have a great evening. Thanks, Rich. Fool on.